Continuing with their buyback plan. Total, on the other hand, having a very different rate. So it might be a tale of two energy stories there too, Anna. And of course, Airbus breathing a sigh of relief, at least when it comes to some of the analyst commentary. They've reiterated their outlook. This is a positive sign given some of the supply chain issues we've seen in the industrial space.
Yeah, absolutely. You can tell how busy it is when we haven't really mentioned Airbus yet. We've had plenty of news out the auto space from Stellantis and VW. We'll find time to get to those stories shortly, but we'll certainly see how that sector responds to the news flow at the start of trade. This is then the open of Thursday's session. The FTSE 100 a little negative out the gates this morning. The IBEX down by 0.7%. And perhaps we focus a little more on the IBEX today, given those Spanish bank earnings that we've had out this morning. Interesting reporting surrounding windfall taxes in the Spanish media around where they are going to be continued next year and where they're not. So we'll continue to watch how that one plays out. Stock 600 then as a whole down by 0.3%. So the energy space, the banking sector in focus, autos in focus, aviation in focus with those numbers out of Airbus. A lot of moving parts today, and Chrissy, that's before you even get to the tech sector over in the United States, Microsoft, Meta, and any read across there. Looking ahead in tech, we're going to get numbers out of the likes of Apple and Amazon, but for the moment, what does the sector breakdown look like?
Well, it's a really interesting one because the top of the pile when it comes to the index contribution is the one company we haven't given a lot of love to, and that, of course, is Airbus here this morning. Higher by about just shy of 3% in the early trades, but it is some of your biggest upside movers. But then right off the back of it, you got HSBC and you've got Shell. So again, banking and energy seem to be the big winners, at least when it comes to the UK, but the biggest losers when it comes to France. And from an index contribution as well, at least from the early trades you're seeing in the stock 600, not necessarily in the benchmark French index, is BNP and is Total. And that's really where you're seeing, again, the most movement. Banks, energy, but a regional divide as opposed to a sector one this morning, Anna.
Yeah, really interesting. It does seem as if all sectors are in negative territory, which tells you something about the negativity here in markets. We have the retail sector as the worst performer. Rubis, we haven't mentioned, but that was seen as a weak spot before the start of trade, and indeed it is. That stock down by 5%. I was going to say to the upside, but it's not the upside, is it? But the most resilient sector, basic resources, where we do see some stocks gaining, but only two. Anglo-American is one of them. That's up by 1.1%, but elsewhere, quite a lot of negativity. We don't have all of these markets open yet in their entirety. So the CAC and the DAX taking a little moment to open up. So we'll see how those individual, those markets perform, and indeed some of the building blocks to that. Should we talk about what's going on in the UK gilt market then, Chrissy? Because we've actually seen the 10-year yield rising 6 basis points. UK bonds dropping, the 10-year yield rising 6 basis points. That's the headline I see across my screen. We'll get the, there you go, you can see the extent of that. So yields rising 5 basis points or so, let's call it 4 or 5 basis points, it seems, across the curve. Perhaps showing us, it's continuing the direction of travel that we saw after Rachel Reeves had spoken yesterday. And as we were hearing from our colleague Rachel a moment ago, there were these twin worries around the level of borrowing, and that was underscored by what we heard from the Debt Management Office, and then the inflation impact, and whether we need to reprice our expectations around rate cuts from the Bank of England as a result of, for example, higher minimum wages in the UK.
Yeah, it's a fascinating one as well, and already you're seeing a little bit of commentary come out from certainly the PE players on the carried interest piece as well, You're also seeing some of the capital gains pain as well. We should mention, though, in context of the UK, you are seeing yields higher, of course, in the UK. You're seeing yields higher across the rest of the continent as well, especially when it comes to Italy and Spain. It looks like some of the periphery is trading a little bit more volatilely than the French and then German debt is as well. We should also fairly quickly mention in terms of front things. We are seeing pain when it comes to BNP and Total. Stellantis is actually one of the sole performers in the green, Anna. We've talked about this in terms of their margin really taking a hit this morning, but also still reiterating that going into next year, they may be talking about a buyback. Those shares higher by 0.5%. It kind of feels like this morning, at least from the surface, buybacks may be coming to the rescue.
And the Shell story underscoring that.
Exactly.
Yeah, that's one of the few stocks that's higher on the London market. The Shell share price up by 1.4%.
Yeah, well, let's get an expert on buybacks, shall we? Sharon Bell, Senior European Equity Strategist over at Goldman Sachs, joins us around the table. Every time you come here, I ask you about buybacks, and I can't get enough. How much of buybacks can rescue some of the European stock market at a time when earnings are slowing down?
Yeah, we don't expect much earnings growth next year, 3 or 4% for the next few years for European companies. This year, you're right, earnings, I don't think the earnings season's been too bad so far, but that's partly because the hurdle rate was quite low. People were revising down beforehand. But yes, European companies are using a lot of their cash to give it back to you, either in dividends or buybacks.
Right. It's a fascinating one as well, because we saw this dynamic in the banking sector predominantly, and now it kind of feels like it's showing up in other sectors as well. But I'm curious how much of the buybacks kind of momentum can really continue in the face of things like windfall taxes, for example. Is this even being priced into this market?
Yeah, I think actually buybacks, although they'll be quite strong next year, I do think that they probably peaked this year in terms of their amounts. And one of the reasons for that, it's not just the taxation, although that may be part of it. I think it's also that energy prices haven't been so strong this year. The energy sector is a sector that buys back a lot of shares. So commodity earnings perhaps won't be quite as good. So the momentum in buybacks, which really accelerated, and as you said, we talk about it every time that I'm on, the momentum in buybacks has really accelerated in recent years. I don't think it will go back to where it was, say, pre-pandemic, when we didn't have so many buybacks in Europe, but this year's probably the peak.
Let me ask you mentioned there about taxes, and let me ask you about that in the UK context then, Sharon, because we've seen where this new government in the UK wants the burden of tax increases to fall, and it does seem to be on the larger end of the corporate space, doesn't it? What does that do to your expectations for UK stocks then, or do you draw a line across the channel to other geographies? Tell us your thoughts.
Yeah, look, I think you're seeing taxation rise in many cases, aren't you? In France recently, you've seen taxation rise. It's been talked about a lot in Italy and elsewhere. Governments are under pressure, so taxation is rising, and corporates are also taking a share of that rising taxation. I would say in terms of sort of UK domestic companies, they may be facing a little bit more taxation, but they're also possibly facing a little bit more growth in the next couple of years too. Data in the UK has been okay. I think this budget is a little bit of a fiscal expansion, which increases demand as well. So I think there are positives and negatives for them.
Yeah, and what about the tariff environment? So we are working our way towards the US election, of course, and European businesses very much in focus when it comes to tariffs that we could see imposed by a Trump administration, if that's what we see. And even without a Trump administration, we're seeing more tariffs being used generally. So the Europeans talking about putting tariffs on Chinese cars really imminently. How are you factoring that into your European assessments?
So I think tariffs generally for Europe as a region would be quite a large negative, even if it's Europe imposing those tariffs. First of all, if you're imposing tariffs on goods coming in, that increases your inflation, increases your cost for consumers. If tariffs are being imposed upon you, then clearly that's not great for your producer or export business. And Europe is so reliant on global trade. So I think from a sort of relative regional international basis, Europe really loses out from any contraction you see in trade growth.
What's the bigger geopolitical risk? Is it the relationship with China, or is it the relationship with the United States?
You know, I'm quite frequently asked this question. Absolutely perfect question I get from clients as well. I think both are extremely important, I guess, is the answer. I mean, the US is about a quarter of European company earnings are made in the US, so it's very big. But a lot of that is European companies owning US businesses rather than producing in Europe and exporting. But still, the US is obviously a crucial economy for Europe. For China, the exposure looks a little bit lower on paper. Only about 10% of earnings and sales are made in China. But China's been the better growth in up until very recent years. Also China tends to be a little bit more volatile, so often quite more important for prices. So I think both, unfortunately.
So thinking about China, you take us to the next perfect place for our question to wander to then, Sharon. We had data out of China. It's been such a busy morning that we haven't actually got much mention of the Chinese PMI data. But, shall we celebrate? Manufacturing PMI above 50 in expansion territory. That's the first time in many months that we've seen that. And some people are joining the dots to the stimulus. Others saying it's too early for that. More stimulus perhaps to come because it still wasn't a kind of blowout number. What does all of this mean for Europe? Are we still seeing European businesses very tied to what happens in China, or are they working on reducing those ties?
So I do think that European businesses, they spent a decade, maybe 2 decades, building up exposure to China, definitely. And I don't think they're doing so much of that now, partly because China growth has been much weaker. These most recent figures notwithstanding, pretty much every other data point has been extremely weak. So that's been very weak, but also the geopolitics as well, and the potential for tariffs and trade wars, etc. All of that, I think, is leading to a bit of a reshoring either back to Europe or to the US. But, obviously there is a big China stimulus coming through now. China data has been extremely weak, but probably bottoming at the moment, and you will see better growth next year on our view.
We have so many profits right now kind of still sloshing around in the system. Even if the earnings are slowing down or even staying kind of stagnant, it feels like there's still corporate profits that are perhaps a little bit of an excess on certain balance sheets. And I find it interesting that some of it is buybacks and some of it is dividends, some of it is payouts. But then it's also, and then some of it's going to taxes, of course, but then it's also consolidation. And we talk about this a lot in the banking sector, but it feels like other players are looking at this as well. What gets in the way of that? Do you foresee more consolidation? Is that something people should be trading on, this M&A pickup?
I think, generally speaking, sort of corporate activity has been very low in recent years. You see fewer IPOs. You've seen, certainly last year, very little M&A. M&A has started to pick up this year. And I think that now interest rates have peaked and started to come down. That's very helpful in terms of encouraging businesses to think ahead and say, okay, now I know where interest rates are peaking and where they may go in the next year or so. So I think that's helpful. And I think that European businesses in particular, their valuation discount to the US is very, very large, as we discussed before. And there's not a lot of top-line growth around at the moment. As we just discussed, earnings estimates coming down. So how are you going to generate that? You can often generate that through things like more aggressive use of cash. You can do buybacks, or you can perhaps buy something, cut costs, expand your market share, etc. All of those things are open to you.
It's a shame Guy Johnson isn't here to talk about PE multiples. You would have baited him right there. But I think she makes a crucial point in this kind of pickup in M&A activity as well, because look at every single bank earnings we've had this morning. They've talked about fee income turning to the investment banking. But the more you do that, the more deals you get, the more antitrust scrutiny you get. And we talked about it in the context of Spain, but you see it in the States. We had the DOJ on a couple of weeks ago, and you see it in other sectors as well. So it's almost kind of a catch-22, but what you do with all that money.
Right, yeah. So if you go more for fees, you go for more for M&A. Right. What's the climate like for that M&A to actually get done? I want to take us to another part of the universe, Sharon, and that is what's going on in gilt markets. We talked about the budget and what this means in terms of tax. We do see yields ticking up again this morning, up by 6 basis points at the 10-year horizon. And the rest of Europe is also moving higher, but the UK is moving a little more in terms of those yields, so up by 6 basis points now. What do you think this is telling us? I was looking to see whether on the FTSE 100 we were seeing those rate-sensitive stocks weakening, and perhaps we'll see a little bit of that. What do you make of that slightly higher gilt environment?
I agree. So I did say that, we've upped our GDP forecast for this next year for the UK a little bit because of this fiscal expansion. But the negative side of the fiscal expansion is there's more borrowing that's needed for it. So there's more borrowing, a little bit more inflation, because an increase in national insurance for employers is a little bit inflationary. Increase in the minimum wage is a little bit inflationary. All these things are a little bit more fiscal spend is inflationary. The bond market's a little bit worried about that. So bond markets everywhere have been selling off. You're right. Yields have been rising, but I'd say particularly in the UK.
And I know this is maybe going a little outside our comfort zone, but how much is worry about the bond markets and issuance and supply, and how much is just factoring in, okay, the Bank of England won't cut quite so much because of that?
Look, I think both. Again, a little bit is the answer. I don't think it's as worried about the fiscal position as perhaps bond markets in the UK were a couple of years ago. But there's definitely been a slightly fiscally expansionary budget, a little bit inflationary, a little bit more growth, and a little bit more borrowing, and all that mix. It's not perfect for gilts, and that's why they're selling off.
All right, Sharon Bell, Senior European Equity Strategist over at Goldman Sachs. We thank you so much for joining us around the table. Let's go a quick check on the core six, the main stocks that are, of course, potentially moving this market in terms of the heavyweights. Red on the screen across the board. You are seeing the biggest hit, it looks like, in Ferrari, actually, but right next to ASML. It feels like ASML may be that tech read-through that we got over in the States as well, despite being a chip equipment maker and not a cloud services. But nevertheless, sentiment certainly in the red. Let's go from the macro to the micro. Get a little bit more of an update. Joe Easton, I'm sure, kind of trying to drink out of a fire hose this morning. Joe.
Yeah, there's plenty to choose from today, Chrissy. Firstly, starting in the bank, some big moves over here. We're seeing SocGen over in France jumping. This is mostly due to their trading business, fixed income, looking really strong. We've had some news of some management changes over there as well. But take a look at BNP Paribas, absolutely slammed, down 6% in early trading. Now, analysts over at Citi are pointing to a weakness in some of their capital. Also, they do have a vehicle loan business as well, and Citi pointed to some declines in sales for that one as well. ING coming down in Amsterdam, another decliner in the banking space. Net interest income does seem to be the weak line on that one. Then we have also got the banks over in Spain reporting. There are several out today, and the ones that we've had with management on the shows this morning, Banco Sabadell, that one coming down, and BBVA, of course, the company that is looking to buy Sabadell in that hostile takeover situation. Both of them weakening. Both companies are heavily exposed to the decline in net interest income as well, which is a bigger problem in Spain than the rest of Europe, notably, for those lenders. Then in terms of Airbus, this one is looking more positive. Finally, a bit of good news for this one. It has been hit pretty hard given the production issues there, and they are seeing a bit of an uptick in orders, potentially meaning some of that is now starting to ease finally for Airbus. Then over in semis, two very different moves in the market this morning. Well, actually, ST Micro actually has paired its move since I've come over to the studio. That one was down in early trading. Ixtron, meanwhile, jumping. This is in semi-machinery. It is down around 40% year to date. It's kind of coming back following a sales result there. And ST Micro looked really negative given the exposure to the decline in the autos market and EVs, but actually potentially all that priced in at the moment. Quickly, ABI is the maker of Budweiser. That one is declining. There we go, actually adding to the losses following the slowdown in Bud Light sales. Smith & Nephew, the worst performer on the entire European market today. Medical tech in the UK weighing on the FTSE 100 following week sale. Finally, we've had way too many earnings, haven't we? So we'll do a morning call. Burberry upgraded, the second upgrade in 2 days for Burberry. Yesterday, it was the analysts over at Barclays. Now we've got HSBC upping Burberry to buy, potentially signalling a rebound. We're up 1.7% on that luxury stock this morning.
Joe, thank you. Joe Easton from our equities team with an update on, yes, all the earnings and also some broker moves. Coming up on the programme, we'll get back to the Airbus story. That's certainly one we need to dedicate a bit more time to. Airbus supply chain turmoil continues, but the plane maker is signalling confidence in the path forward. We will bring you the details. The share price moves a little bit higher this morning in contrast to the rest of the markets. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
season is here.
I think that this earnings season is going to be so important.
Bloomberg is first to break the numbers.
NVIDIA earnings now crossing the wire.
Bank of America, the retailer Five Below.
There is something for everybody.
With the smartest insights.
Weaker inflation is not great for earnings.
I think the consumer's a bit more resilient.
You've had earnings recessions flow through growth and then cyclicals and defensives.
Earnings cycle continues on Wall Street.
Continuing coverage on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The top names in business are on Bloomberg.
A lot of things we've done which I think are bad, whether you're Democrat or Republican and you support, it's often done in the name of good, have hurt the lower 20%. They're dying younger, their incomes didn't go up for 20 years. They're the ones who have more crime-ridden neighborhoods, their schools don't work. I think we have to be very clear-headed about how we can accomplish what we want to accomplish to lift up all of America.
Nobody covers business like Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
We have difficulties month after month to execute on the ramp-up. We have a quite difficult end of the year ahead of us, the year-end rally, as we call it, as we anticipate to have more than 200 planes to deliver in the last 2 months.
That was Guillaume Fauré, the Airbus CEO, of course, talking about the performance of the business. The world's largest plane maker has reaffirmed its 2024 delivery goal, underscoring the focus on ironing out supply chain glitches that have hampered production plans. Let's get further into this story as the Airbus share price ticks up this morning. Bloomberg's aviation senior reporter Sid Phillip with us on set. And Sid, you know, this is a business that, given the troubles at main rival Boeing, should maybe be doing better than it is or having a smoother rise than it is. Talk us through the challenges they still face.
Yeah, so Airbus has really struggled to come back from the pandemic. I mean, they had very ambitious growth plans as they ramped back up from the pandemic. But unfortunately, the supply chain hasn't really been able to keep up with that. And that's really been the biggest challenge for Airbus. So they've set themselves really big targets, and then they've sort of come short because of the fact that they aren't able to sort of meet the, like, supply chain isn't able to meet the demand and isn't able to ramp up as fast. So they've ramped up hiring, but the supply chain is still struggling with workers, is still struggling with supplies, raw materials and other things. And so that's been a big challenge for Airbus. And I mean, Airbus is, like, there was a lot of expectation that Airbus would downgrade its forecast for the year, and that did not materialize. So they've set themselves up a huge challenge of building around 240 planes in the next couple of months, in this current quarter. And so it's a big challenge for the plane maker, especially as they sort of try and get those deliveries out, because I mean, there is a lot of demand for those planes, and unfortunately Airbus just hasn't been able to meet that demand.
Talk to us about the management changes.
So Airbus they've talked about how they're going to get a new CEO for their commercial aircraft division. They've talked about bringing in Lars Wagner, who currently leads engine part maker MTU, and he's going to join Airbus in 2026. That division is currently led by Christian Scherer, he's a veteran of Airbus. He's been there for 40 years. And so he will sort of hand over to Lars, and essentially Lars is more an operational person, whereas Christian Scherer has been more of a salesperson. So I think that also sort of addresses what the challenges Airbus faces in terms of trying to get production back up, trying to get production going, and that's what analysts are talking about, how they're getting a production person in charge of the commercial aircraft division.
A lot to digest there. Bloomberg's Sid Phillips walking us through the Airbus story, of course, one of the major movers to the upside this morning. Let's talk about the other side of the coin here. And the major kind of underweights, Microsoft, Meta, both taking a beating in pre-market trading in the United States here this morning. Microsoft shares down about 3.7%. Meta, shares down about 3.8% as well, all weighing on the futures picture. Let's focus in on those big tech results. Take a listen to what Microsoft CEO Satya Nadella had to say about their outlook.
All up, our AI business is on track to surpass an annual revenue run rate of $10 billion next quarter, which will make it the fastest business in our history to reach this milestone.
for more on this, let's bring in Bloomberg's executive editor for tech, Peter Elstrom, who I'm sure is also kind of drinking out of a fire hose this morning. Let's start with the Microsoft story as well. Walk us through the spending effect.
Right, well, we're beginning to get this picture of what is going on with the technology companies right now. We're going through a very intense week of earnings results. We got Alphabet yesterday along with AMD and now Microsoft. And one of the big surprises that we're seeing is exactly what you're alluding to. These companies are spending so much money on CapEx right now as they make big investments in AI. In particular, they're building new data centers. They're buying a lot of chips from NVIDIA, which are very expensive at this point. And at first, this report from Microsoft looked pretty good. Revenue was up 16%. The cloud computing business was up 34%. That seemed to be pretty strong. But a lot of what was a challenge for them is as they talked about the spending going forward and also the growth in the future, it looked a little bit softer than expected. It looks like the Azure cloud computing revenue business is going to slow down just a bit. It's only by a couple of percentage points, but because investors have seen all this capital spending going on, record capital spending for the company, they want to see those numbers going up, not slowing down at this point.
So there's a sense that maybe anything to do with AI is potentially priced for perfection right now, Peter, and you've got high expectation and you need to deliver on it. On the other hand, though, it's almost a nice problem to have that Microsoft can't quite live up to can't quite supply all of the demand around data centers. So it's not as if they're giving us the message that there isn't the demand for the AI product. It's just that they can't keep up with that demand.
That's right. They're supply constrained at this point. So they're at record capital spending. Their capital spending was up 50% from a year ago. The CFO, Amy Hood, though, said that they are having a hard time getting out the data centers, building the data centers as quickly as they would like right now to be able to meet the demand that you're talking about as they try to sell these AI services to the customers around the world.
Let's talk a little bit about Intel as well. Sticking with that chip space, we talked about the kind of outperformance of Microsoft. Do we see it show up in some of the chip makers? I know completely different businesses, but that tech sentiment, does it show up there?
Well, everybody wants to find out what's going to happen with NVIDIA in particular. We're going to have to wait a few weeks for NVIDIA right now. We did get AMD yesterday. AMD's results were a little bit light, but it's not clear whether that's a slowdown in demand for some of the AI chips or whether they're not gaining as much share against NVIDIA as people had anticipated. For Intel, I think the story is much more basic at this point. They've been having so many financial problems. They're really struggling to be able to get the CHIPS Act money that they want to get. They have troubles in their foundry business too. So people want to see that Intel is regaining its solid financial footing so that they can build on some of the potential that they've got in foundry and also in their basic processor business. Moving into the AI space for them is an aspiration, but they're pretty far away from that at this point.
And if we circle back to some of the earnings we had overnight, Peter, Critty was started by talking about Microsoft and Meta, both under pressure pre-market because of earnings. Right. The Meta story, are we back to worrying about Mark Zuckerberg and how much he wants to invest in bright, shiny new things? That seems to be a perennial concern.
I mean, when Facebook came out, it was a very capital-light business. You didn't have to spend a lot of money on these things, and now we've seen him spend billions and billions of dollars on the metaverse, his aspirations for the metaverse. AI is the next fixation for him. So he's warned investors that he plans on spending very, very heavily going forward. Again, the stock has done great this year. It's up more than 65%. It's done very, very well. But they like to see him cash in on some of those profits rather than continue to spend so aggressively into the future.
All right. Bloomberg's executive editor for tech, Peter Elstrom, staring down the barrel of these pretty big hits from Microsoft and Meta in terms of the pre-market. Coming up on the program, we switch back to the banking sector right here in Europe. BBVA and Banco Sabadell shares both down in today's session, despite both having net income beats. It looks like their lending revenue is what's getting the hit here. We're all going to be speaking to the Banco Sabadell CEO next, as, of course, we await a decision on the takeover bid from BBVA. A lot going on, two exclusive conversations. Everything could change in just 2 short weeks. Stick with us. This is Bloomberg.
In case you missed it,
on Bloomberg Technology.
We are very focused on playing one game and one game only, and that is being free, frictionless entertainment for consumers. But what I will say is we are doubling down on the strategy. We believe it's working. We think the tailwind's in our favor, and it's on us to continue to deliver.
Whenever you're doing something innovative that hasn't been done before, there's a lot of trial and error and iteration. It just always has these zigs and zags along the way, and I think where we've been successful is really being reactive.
Hollywood is the history of technology. Like, we are here because of a technological breakthrough, right? And so we sometimes forget that art and technology kind of like come together always. And for us, it's like demystifying a little bit the technology. Again, if you understand AI as a tool for humans, then it changes the narrative. And it's less about fearing it and more about embracing it.
Don't miss Bloomberg Technology, live every weekday.
The top names in global leadership are on Bloomberg.
It was important that when we came into office, we looked at the books, we assessed the state of the economy. We needed to understand the damage that's been done, and that £22 billion black hole is a real problem that we've got to deal with, and make sure that we go through all the processes necessary for a properly thought through budget.
Nobody covers the top global leaders like Bloomberg. Context changes everything.
Public health saved your life today, but you didn't even know it.
Viruses, pathogens, threaten to bring us to our knees.
We need to tell the story of public health.
I'm really worried that any pandemic can just, because we are not yet prepared.
Inequality is a root cause of illness.
The trust level is broken.
It's the politicization that's killing us. Public health is like the foundation of your house. And let me tell you, ours is cracked.
Politics to the world of business. Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
This is the opening trade. We're about 30 minutes into today's session. Seeing red on the screen across the board here. It looks like a little bit of weight in the European session. Although pairing some of the losses that we had seen, it is ultimately a story of what's going on underneath the hood. You are seeing some of the pain in some of the energy stocks, some of the banking stocks as well. And that's where I want to go next. Of course, Spanish banking is top of mind as we await some of news on the BBVA Sabadell deal, but also both companies coming out with their earnings this morning, especially in a decelerating rates environment and a takeover bid. There's a lot to discuss. I'm pleased to welcome the CEO of Banco Sabadell, Cesar Gonzalez Bueno Meyer, joining us this morning. Cesar, a pleasure to have you on the program as always. Let's kick it off with your earnings as well, especially at a time when we're talking about decelerating interest rates, this kind of pressure on margins. Walk us through your numbers. How are you pushing back or making up some of those losses in interest income?
Well, the first good news is that we are 26% up. Year on year on net profit. It's a record. In the first 3 quarters, we've made as much as in the whole year of last year, and our return on tangible equity is also at records high. Why is this? Of course, negative interest rates are having an impact, that for sure. But in our case, it's much milder. 60% of our activity with clients, of our assets with clients, are at fixed rate. On top of that, we have managed the book in order to make it more resilient to downturns. And furthermore, we are having TSB, our bank in the UK, picking up because of the Caterpillar and other effects. So they are, for the first time in this quarter, up in terms of net interest income. So all in all, record year by far, and a very good equity story, I have to say.
Cesar, it seems that the market is a little concerned about the net interest income, but you've responded on that. Also, perhaps a little concerned about hyperinflation in Argentina and whether that is having an impact on your business. What is your experience in that part of the world?
Well, our experience in that part of the world is very limited. Contrarian to BBVA, who has more than 70% of its income in emerging markets. In our case, it's only 4% of our equity, which is in Mexico. So we are basically a Spanish bank with a big footprint in the UK through TSB. And therefore, all that doesn't have an impact. All that the decline, both in results, but also the shakiness of the exchange rate of the different currencies is not affecting us at all because we are not present in those markets.
Okay, yes, apologies. Sorry, this was more of a thing that's affecting the Spanish banks as a whole rather than you specifically. But that takes us nicely into the conversation around M&A and your pushback against a BBVA acquisition. You've said recently that BBVA is a Mexican bank in euros. What did you mean by that?
That's very simple. 50 to 60% of their profits come from Mexico, and more than 70% of their profits come from emerging markets. So in reality, it's not fully a European bank. And that's why I think consolidation in Europe is something that we should all look forward to, but it should be among European banks.
Well, Cesar, that's the argument from BBVA, with all due respect, that with the combination of Sabadell, you have the ability to compete on a larger scale across Europe and not just in Spain. I'm curious, though, in terms of your contingency plan, you've been very vocal that this is not a merger that you're looking forward to, but given that there could be a scenario where BBVA has a majority stake in Sabadell, what is your contingency plan?
I don't think there's no need for contingency plan. I think it's not going to happen. The price is not there. It's not friendly. And there's a major rejection for society at large. Why is the price not there? You have to take into account that just in the next 18 months, Sabadell is going to return in terms of capital 30% of its market value. At 2.9 billion, which is what we have committed to distribute between this year and the beginning of next year, I mean, between next year and the beginning of 26, that's 2.9 billion is 30% of our market cap. That's hard to beat. And that means that in the end, I think our shareholders are going to consider that there's much more value creation at this bank, which has been top performing for the last 4 years and still has a long way to go.
Well, Cesar, talk to us a little bit about how you can make this more kind of interesting. And at a conference, an investment conference, you've recently said that there's potential improvement to your payout plans, given that the BBVA offer, in your view, is not at fair value. What is fair value, in your opinion?
Well, fair value is always a moving target. I think that in relative terms, and that's what every CEO will always say, we are undervalued. But you only have to see the trend of Sabadell during the last 4 years. We have multiplied our value by 5.2 times. That's a 420% increase in the course of 4 years. We are best performing bank in Europe, across Europe, and best performing stock in the Spanish stock. And this trend is continuing. This year, we are up by more than 60% and only 4% since the offer occurred. So we are in a very positive trend that hasn't finished because we are still improving our processes, our performance, our commercial activity, our cost of risk. It's banging from all engines and lots of good things to come.
Well, lots of good things to come, but Cesar, with all due respect, the market doesn't necessarily see it that way. Yes, your stock is up a pretty decent chunk in the last year, no doubt about it, especially after this kind of takeover offer from BBVA. But we're showing a chart on the screen right now that talks about price-to-book ratio for both BBVA and Sabadell in the last 10 years. The market is saying that it's not reflected what the outperformance of Sabadell actually is when it comes to this particular metric. And I'm curious, when it comes to your view, what the market is missing here, if not the ability to, with BBVA, surpass the market share of the likes of Santander. Is that not appealing to you?
No, I don't think size, for the matter of size, is anything appealing. The most performing bank in Spain, it's one that is smaller than even us. So size and profitability are not necessarily correlated, and as a matter of fact, we see very often that it's not. Especially if it is in different places of the world, in different markets. So concentration in certain markets certainly helps. But it gets to a point that it affects also competition. 1 in 2 SMEs is a client of Banco Sabadell in Spain. And our net promoter score, which is an index of satisfaction, is extremely high. It's #1 also. So we are correcting all the elements that in the past that didn't allow our performance to be so spectacular. But as I said, we've multiplied by 5.2 times the value of the stock in 4 years. And when there is a trend, there's always a catch-up. Every year we have been adjusting to the prospects of the financial advisors and the analysts. Every year we have catched up. And now we have a significant upgrade to 225 in their view, and that's what we are aiming. And we usually catch up in the course of a year. So the market is giving us more value, but it takes time, and we are aiming for that.
Well, Cesar, first off, with all due respect, you mentioned that BBVA is a smaller bank. It's not in terms of market share for deposits, customer loans, and mortgages. That's just coming from Bloomberg Intelligence Research. But you mentioned that key piece, which is time. And this is something that both the folks over at BBVA, Carlos Torres Villa, the chairman, as well as the CFO, had recently said on our program. Take a listen. I just want to play what their comments are to you, what they said about that factor of time. Luisa Gomez Bravo, take a listen.
Time is, as Carlos mentioned, is something that is not good for the deal, and we acknowledge that. But again, this is in the hands of the CMC, and whatever the time frame, which in any event we're expecting this to be in the next weeks, few months, we will see no competition issues coming from the deal with no structural remedies involved.
Cesar, that was the CFO of BBVA saying that she sees, no issues to this deal, but that time is ultimately the enemy of this. How long are you willing to fight after the CNMC decision in, say, 2-3 short weeks?
Well, the CNMC decision is probably going to extend. And what we expect is that the deal will only come to the market and the tender will be open around the summer next year. So it's not in our hands. It's exactly how the process of approvals works. The competition issues that are identified are very, very significant. As I said, 1 in 2 SMEs is a client of Bank Sabadell. So therefore, the fact that we would disappear would affect significantly competition, and that's putting time on the table. During this time, what has happened since April, since the offer was on the table, that BBVA is down by around 14%, 17%. It's oscillating there. And we are up by only 4% in line with Caixa and with Bank Inter. So we are all following the market, and we are exactly where we stood at the beginning when the tender was proposed. I mean, when the offer was proposed, and then when the hostile takeover happened, and they are down in line with the Mexican peers and the evolution of the peso. So in reality, yes, I agree that for them, time is not helping because the performance of our stock in relative terms is significantly superior. Time doesn't help them. That's true.
Cesar, can I ask you about something else, which is taxation in the Spanish market? We're seeing reports in Spanish media that the windfall taxes on energy in Spain might come to an end soon, the end of this year. But on the banking sector, we might continue to see windfall taxes. What do you understand is the government's position there?
No, I think what has been published is exactly what you're saying. The windfall taxes in banking are going to continue, it seems like, but they're going to be relatively milder to what they have been until now. So that should be, in relative terms, some improvement.
Cesar, thank you very much for joining us. Banco Sabadell CEO Cesar González Bueno, Mayor, with an update on how the performance of the business is going and the pushback against that attempted takeover by BBVA. We thank him for his time, an ongoing story we continue to track. If you would like to talk to us about what you think of Bloomberg TV programming, then we would like to hear from you. We put together a short online survey. You can click the QR code that's on your screen right now to tell us what you'd like to see more of on Bloomberg TV and anything you'd like to see change. We will use your feedback to make the best programs that we can, of course. Much more ahead. This is Bloomberg.
on fast fashion. It's been transformative. It gives the masses access to fashion, but there's a cost to it, downside to it.
My first notice is too much waste. I think this is also how I grew up, making your own clothes and making something that's well special and well unique. It's like timeless. And now you see that everybody is looking the same, wear sweatshirts and wear T-shirts. And for me, it's just like when they wear something that's special, they feel empowered.
Is there a need for fashion to be more mindful of the impact it's having socially, environmentally?
Definitely.
Is it happening enough?
I think it's happening. It's gradually happening. All the designers are doing, everybody is thinking about this subject at this moment, thinking how to be more sustainable, how to be more environmental friendly.
Do you think the fashion industry is doing enough, to ensure that it is sustainable? There's so many targets out there. Are they even realistic in wanting to achieve them?
I think some of them are just like they're using the sustainable ideas as a marketing concept only. They're actually not really doing it. I think as a designer, it's really important to really make it happen. Every collection, I think about how to do it and how to tell the customers. I think that is our responsibility to educate our customers.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion. So I think what Europe needs to think is to start thinking about its common interests rather than the interests of each of the countries, right? I mean, one problem with the European economy is that it's fragmented at the national level. I'll give you one statistic that I think is really interesting, right? In Europe, there are over 30 telecoms operators. In the US, there are 5 or 4. In China, there are 5 or 4. Essentially means that European firms are smaller. I think what it means is that it's less global and more bipolar.
Citadel's head of economic research there discussing Europe's struggle to unite and how it's leading to a more bipolar world between the United States and China. This is, of course, as we zero in on the relationship between the United States and China. It's part of our daily series on the issues facing Europe in the battle between Kamala Harris and Donald Trump. We're just a few short days away from when Americans hit the voting booths. Our next guest is an expert on China, Robin Niblett, distinguished fellow over at Chatham House. He's also author of the book, The New Cold War, How the Contest Between the U.S. and China Will Shape Our Century. Robin, a pleasure to have you on the program. We talk about this often from a market's perspective of whether Europe is more responsive to the China side or to the American side in terms of where they get kind of caught in this trade struggle. Your perspective?
Well, my perspective is they've got no choice. They'll get caught on America's side, especially if we are in a new Cold War, which is certainly my interpretation. Europe relies on America even more as an ally and for its own protection than it did for a long time, really since the end of the last Cold War. And so China, to the extent that China is supporting Russia in its war in Ukraine, the Europeans get pulled even further onto America's side. Obviously, that worked quite nicely in the Biden administration. They've been relatively aligned, even though the Biden administration has done some things that have upset the Europeans, the Inflation Reduction Act being the clearest example.
Yeah.
But despite that, at least they've been reliable allies, and they've tried to kind of respond to China together. The fear and the danger is that if you have a Trump administration, he will respond to China separate from Europe and will leave Europe to its own devices.
When it comes to those kind of retaliatory tariffs, though, it feels like this is an instrument that has really been used initially from the United States, but that Europe is kind of trying to learn how to do. It also comes in the context of this idea that we do have, I believe, an envoy today being sent to China around perhaps discussions around these EV tariffs. Do you think in the fallout of U.S. and China, specifically around raw commodities, you could start to see the EU take a more pro-China approach?
I think pro-China would be too strong a term. One problem Europeans have is that if the United States imposes strong tariffs on China, there's a blowback effect into Europe, because in essence the Chinese then end up exporting more to Europe, which is their largest market in the world, the US being roughly third if you count ASEAN as a whole as their other major trading partner for China. So the Europeans are almost forced into at least mirroring somewhat the US trade policy towards China, so they don't then become the market and the alternative market. However, as we saw with EV tariffs, they've tried to take a sort of legal approach. We're going to discuss with each company, and to the extent that they engage in the subsidy investigations, we will tailor the tariffs, and they've been anywhere between adding 35% and 17%, very different from the Harris administration. So they're trying to say to China, look, we are a reliable trade partner, but we're not going to be rolled anymore. And if you talk to Europeans who operate in China, including a lot of the companies that try to sell into there, they feel the China barriers to their trade are massive and have not reduced. It's fine if you're a European company operating inside China, maybe those barriers aren't as strong, but you're now getting outcompeted by the Chinese partners, as we've seen with the EV market and Volkswagen and others.
Yeah, and Robin, it does seem from what you're saying then, if we're in this new Cold War, it does seem like we are going to be in a much less globalized world than we've known over the last few decades. How far do we unwind that globalization?
The way I think of it is it's almost like sort of reversing into a new Cold War. The two sides got very close together. I think the Chinese knew well in advance at some point the US was not going to allow a peer competitor that was a one-party Communist Party state. And they've been kind of hedging and de-risking for a lot longer than the Americans have, or even the Europeans for that matter. How far do we go? Look, I think we're in the first chapter. The Biden administration, and if there were to be a Harris administration, are in a sort of one-way ratchet where each new technology, if it's assessed to have a security dimension, gets added to this famous kind of fence, yard and fence. There's meant to be a small, restricted area of technologies, but it's already expanded beyond AI, beyond semiconductors, beyond quantum, to EVs, to probably go to cloud computing. It's in all sorts of areas. So I think we're at the front end of that ratchet. But if a Trump administration comes in, it's going to be less about sort of security technology and more about just trade. And their re-globalization, which is the term that's being used a lot at the moment, is more about other markets taking advantage of the contest between the US and China.
Yes.
Southeast Asia, for example.
Yes, and we've done quite a lot of research. I think Bloomberg Economics talking about the sort of unaligned countries and the way they're able to pick up the slack. So, Robin, from all we've discussed, I mean, is it too late that we go back to what we would have seen as the status quo with two different contrasting systems in the United States and China? I mean, there could have been we could have written a story that would allow those two to coexist in different regions of the world. Why does that not work?
It doesn't work because we're not getting too sort of political about it, but I suppose I have to be. China and the US, fundamentally, their leaders fear each other. And fear is a much stronger driver emotionally than opportunity. Win-win, we'll lose out to lose-lose if that is the dominant fear, and that's the direction we're heading in. So, look, there are sectors where the US-China trade is still at its probably second highest ever in 2022 was the highest level ever of bilateral trade, dropped by about 100 billion in 23. But the direction of travel is one where that bilateral trade, other than in farming, some other furniture, all sort of areas where it's not security related, is going to get harder and harder.
And Robin, just briefly, do you fear it will take a long time to settle the result of the US election? In theory, we know next week.
Look, you have a lot of close states in the swing states. All of them could swing one way or the other, in which case I think it would get resolved relatively quickly. But if it's down to one or two states, we could be in for a long, long ride.
Okay, Robin, thank you very much. Thank you for your time. Robin Niblett, Distinguished Fellow at Chatham House, author of the book, The New Cold War, How the Contest Between the US and China Will Shape Our Century. A great voice to have as we gear ourselves up for that US election next week. As we just mentioned, Bloomberg has learned that the European Union is sending officials to Beijing to hold more talks aimed at finding an alternative to tariffs on EVs from China. For more, let's bring in Oliver Crook in Berlin, who's been following this. Oliver, negotiations also ongoing between EU, China on EVs. What is the latest?
Yeah, so listen, Anna, we know that we're going to send, we understand from people familiar, yet another delegation to China to continue these discussions and finding ways to potentially circumvent these tariffs and continue these discussions. We should say, Anna, that there have been 8 such talks in the lead up to these actual tariffs coming into force, which happened only yesterday. And now that they're in place, it's going to be a lot harder to break through them than it was previously before. But from what we understand, what they're looking at is potentially an arrangement that would put sort of caps in terms of volumes, potentially prices, potentially quotas that would sort of go around the tariff regime that currently exists. We should say, though, that of course this is very, very complex. It has to all be WTO compliant. It has to go with what the sort of EU and the desires that they have there. And the Chinese, for their part, they want a sort of arrangement that would blanketly cover all of the car makers, which makes this very, very complicated. So an encouraging sign maybe for the automakers that these discussions are going on, but I'd say that at this point it's still a very long shot.
Well, a long shot, but then at the same time kind of being balanced with some of the lower local labor negotiations as well. Ollie, what do we know on that front?
Yeah, so listen, you have also the negotiations that are going on between Volkswagen and the leaders of Volkswagen and the unions there. And we have, from what we understand, this sort of opening gambit, obviously, from management earlier in the week, which included radical action of potentially closing factories, potentially cutting wages across the board. What we understand now, hearing from the chief negotiator from Volkswagen, that if they can achieve their financial goals, they're actually open to potentially not closing the factory. So this was sort of the opening gambit we got earlier in the week. As these discussions go on, we're going to get slightly more contours in terms of where the two sides are. The next round of negotiations, and this is the crucial date to watch, is November 21st, because if they do not get a breakthrough by then, we have heard from the unions that they could start striking warning strikes for Volkswagen across the board starting on December the 1st. In terms of sort of all of the news that we got out of Volkswagen, because we also had their earnings out this week, we've heard now from the analysts who have given now their perspective on all of this. I thought this was an interesting note from Bernstein this morning, entitled, which maybe sets up the stakes for you here, Conundrum at the Last Chance Saloon for Volkswagen, saying that basically management's bold commitment to tackle costs at Germany is very welcome, but its resolve is under fire, is yet to be tested, and they still feel that there is a large chasm between intention and execution, which is perhaps why they've sort of lowered their price target on the stock this morning.
Certainly something we're going to be keeping a very, very close eye on. Bloomberg's Oliver Crook, we thank you so much for breaking that down for us. Of course, Anna, it's showing up in these markets here, red on the screen across the board, and the DAX, of course, not really getting any relief either. Some of that a function of the automakers that Ollie was just talking about, down about 0.4%. In the meantime, plenty in the rearview mirror, but plenty up ahead as well. We've got plenty of data, 10 a.m. UK, we've got Euro area CPI, and then the focus is back to the States in terms of the data, PCE, jobless claims, and then plenty of, well, central bank speak, and even more earnings in the States. I don't even know where to look, Anna.
Yeah, absolutely. We've got plenty more earnings to come. And we'll be pivoting, won't we, between the US data picture and the US earnings story, I suppose, as we go through the session. So PCE, you know, inflation still matters, apparently, so we'll keep watching that one. So we're told, so we'll keep watching that one. But on the earnings side of things, it has been Microsoft and Meta that have sort of set the tone overnight. Are we going to have another day of that? We're looking ahead to numbers out of Apple and Amazon, and of course Amazon takes you very close to that cloud conversation. We want and the AI conversation. We wonder what they're saying there. But with Apple, first glance of how the new iPhone 16, the smartwatches, and the AirPods are doing.
Yeah, that business spend is going to be really, really crucial. Whether it comes from, do you actually see it in hardware, like for Apple, or do you see it for the cloud services? Net, a lot of macroeconomic signals ahead. How is that going to show up in this bond market as well? We're looking at a 10-year over in the States at about 427, 428 if we're feeling good. 2-year at about 416 as well, and continued pressure on the dollar on all of it. Risk sentiment is not positive this morning. Stick with us. That does it for the opening trade. This is Bloomberg.
I'm Joe, visiting from San Francisco. How do you think about the role of technological advances, especially generative AI, on more traditional industries? Thank you.
Yeah, I don't know anything about AI. That doesn't mean I deny its existence or importance or anything of the sort. And last year I said, you know, that we let a genie out of the bottle when we developed nuclear weapons, and that genie has been doing some terrible things lately. And the power of that genie scares the hell out of me. And on the other hand, I don't know any way to get the genie back in the bottle. And AI is somewhat similar. It's part way out of the bottle, and it's enormously important, and it's going to be done by somebody. So we may wish we'd never seen that genie, or we may do wonder wonderful things, and I'm certainly not the person that can evaluate that. And I probably wouldn't have been the person that could have evaluated it during I had one experience that does make me a little nervous, and I'll just explain it. That very recently, fairly recently, I saw an image in front of my eyes on the screen, and it was me, and it was my voice, and wearing the kind of clothes I wear, and my wife or my daughter wouldn't have been able to detect any difference, and it was delivering a message that no way came from me. So when you think of the potential for scamming people, if you can reproduce images that I can't even tell, that say, I need money, it's your daughter, I've just had a car crash, I need $50,000 wired. I mean, scamming has always been part of the American scene.
Good morning from our global headquarters in New York. I'm Menace Craney alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set your agenda.
Tech disappoints. Microsoft drops on a slower growth outlook. Meta warns on AI losses. Apple, Amazon, Intel all up next. Powered by the consumer, the U.S. expansion continues on. PCE and jobless claims, those are on deck. And we are just 5 days to go, counting down to the election with candidates in the final stretch of the swing state tours. Good morning, Manus.
Well, we're in the swing. Good morning, Danny. We're in the swing state of tech, for sure. You got Meta and Microsoft, both underwhelming. You take yourself back 24 hours. We'll talk about this in just a moment. Alphabet was a very different story. Here we are, down 0.8% on the S&P 500, but the NASDAQ dragged lower by over 1%. It seems to be a fixation with daily users and CapEx. AMD also tumbling. So much for the buyback. Saving us at the moment. Roll it over, have a look at the bonds. We were spooked yesterday by the ADP numbers, by the strength of the economy. 233,000 in the ADP numbers. Yields just dropped ever so slightly this morning. Jobless claims and PCE will define maybe the next leg of this bond market.
At the moment, it does seem risk-off led by tech. How much of it, though, Manus, just comes down to expectations and valuations? Alphabet is the cheapest among the big cap tech names. Is that why we got a better response to them? Is this finally, everyone has been coming on this program warning us that valuations are too high. Is this how it shows up in earnings disappointments?
I think if you take your mind back 24 hours ago, and we spent some time on this, which was, it was an efficiency. The headlines were about efficiency within Alphabet. It was about driving AI. It was really that catch-up game for Alphabet relative to their peers. Here we are with Microsoft and Meta, perhaps telling us, yes, we're going to up our game in terms of CapEx, but is there a lack of definition from Meta in terms of upping the guidance on CapEx to what you get at the other side of the tube?
I think that's a great point. It's about the starting point, right? And
yes.
Meta, Microsoft, they've already been showing up with some of their AI. So now it's show us the monetization, show us you can do more than just cost cuts. So we showed you there, Microsoft is extending its decline post-earnings, forecasting a slower growth in cloud revenue. 3.7% is the decline this morning. Let's bring in Bloomberg executive editor for Global Tech, Peter Elstrom. Peter, what did you make of those Microsoft results?
Well, you guys are making a very good point. These stocks have been priced so high at this point. The valuations are very, very high. And these companies are really shifting their business models quite substantially. Microsoft hit record capital expenditures in this quarter. Their spending is up 50% from a year ago. And what people want to see from that is they want to see acceleration in their growth. So the revenues were actually not that bad. Revenue overall was up about 16%. The cloud computing revenue was up 34%. But they signaled that that's going to slow down in the quarters ahead. That's not what investors wanted to see. They want to see these AI investments really paying off at this point, helping with an acceleration in that revenue. So that was a little bit of a pessimistic note, and that's what you're really seeing with the stock price, I think, today.
Yeah, well, I mean, even though AI is getting us to spend longer on Facebook and on Instagram, it's what happens next when you up that CapEx. Let's talk a little bit more about Meta. When you dig into this, daily average users, a little bit lighter than estimated. But I think the market is more focused on this CapEx number that they have upped, and also the reality about Reality Labs.
That's exactly right. Yeah, Mark Zuckerberg has been making these huge investments in technologies that he thinks are going to help the company in the future. Referring to the metaverse, a few years ago, he was completely decided that that was going to be the big bet for the company. We're seeing that with Reality Labs, big losses in that business. And now also they're spending a lot of money on AI, like these other companies we've been talking about, Microsoft and Alphabet too. These expenditures are very pricey for the companies. They're hitting spending levels that they have never done really in the past, partly because the NVIDIA chips are expensive. They're trying to build out data centers. These are things these companies just didn't have to do in the past because they were capital-light businesses. And now Meta is determined to make these investments and hopefully benefit from it in the future.
Peter, unfortunately, we don't have enough time to talk about all of the plethora of tech because we got more today, Apple, Intel, Amazon. What do you think in there is going to be the most interesting?
Well, there are big questions for all of the companies that you mentioned. I'd say for Apple in particular, they've been trying to sell Apple Intelligence. They want it to be their version of AI. They hope that that helps convince customers that it's time to buy a new iPhone. They want to sell these the new iPhone 16 in particular. For Intel, they just have to get back onto solid financial footing. They've had so many problems so far. Investors are concerned about their foundry business in particular, but also their ability to compete in processors and in AI in particular. So they want to see that there's some solid financial foundation underneath the company at this point so that they can get back to growing, get back to expanding. It really is the most important chip maker for the U.S. government as they're trying to build up this domestic capability that's so important strategically in the future.
Well, right now, the terrible M's are dragging us down, aren't they? Microsoft down 3.7 and Meta down 4 1/8. Peter, thank you very much. Context setting the stage there on the tech front. On the macro data front, well, we've got a host coming across the board today. Personal income and spending, core PCE, jobless claims, they're all on deck after the latest readings showed robust growth thanks to the resilience of the consumer. Newbeam's Laura Cooper says this, stay vigilant amid solid numbers, writing, a mix of reflation, positioning, US growth, exceptionalism, fears of fiscal accommodation, and a shallower cutting path have underpinned the bond route that we're in. Heightened uncertainty heading into the US election keeps us cautious. So we've got something for everybody there, haven't we, Laura, in terms of why these bond yields are flexing as aggressively higher as they are. Danny and I have debated red sweep, presidency of Trump, etc. When you look at the pricing of this market, do you think the bonds at 4.30 on the 10-year are already fully priced for a Trump presidency or indeed a red sweep?
Well, I think it's hard to say whether the backup in yields that we have seen can be fully attributed just to that Trump sweep. And I think that's largely because this has come at the same time where we've seen U.S. growth exceptionalism extend. We certainly saw that in the GDP print yesterday with the strength of the consumer spending. So to your question, while we do think that at these levels, you know, it's quite attractive, but we're not yet extending duration because there is a risk that that Republican sweep is not yet fully priced. Yields could extend higher. And that's actually one of the key risks, I think, to our year-end target of 4% for the U.S. 10-year.
With all of that backup in yields that's been happening, Laura, something different happened yesterday. We had good news that meant yields went higher. You mentioned personal consumption, the GDP figures, ADP, and stocks sold off. Are we back to the regime where higher yields are affecting equities, where good news is bad news for risk?
Well, I think actually what's been interesting about the equity market rally that we've seen certainly over the past several weeks is the fact that, you know, this is a market that's been resilient despite the backup in yields. So some of that pullback was actually long anticipated. And I think really what we're looking at now is a market that's focused on U.S. election uncertainty. The potential fear of resumption in inflation is another key risk. And as we're seeing this morning, just those mixed tech earnings. So there's a confluence of factors, I think. And so from a positioning perspective, we are still taking a fairly defensive tilt in U.S. equities. We like dividend-growing companies in particular, and we are kind of leaning still into the tech space because of the profitability metrics, despite some of the mixed earnings reports that are coming through.
If you're nervous about taking duration, when you look at the auctions that we had this week, it was tough to get the 2s and 5s away. I think that's just because of the angst that we have. But the 7s were the strongest bid to cover ratio on record.
Yeah, and it's a great point. I mean, I think demand is still there for pockets of the curve, predominantly the belly, like you mentioned. And if we look at what our view is, I mean, we do still think, the front end to the belly of the curve is going to be fairly well anchored, because regardless of the election outcome, this is still going to be a Fed that is largely data dependent. The front end is most sensitive to that. So if we start to see, data come in, still continuing to be quite strong in the U.S., we could start to see some of those further rate easing priced out. So I think at this point, the 2-year really looks quite attractive in our view, whereas in the duration positioning, as I mentioned, inflation concerns, fiscal deficit fears, I think we're just still taking a cautious stance to that degree of the curve now.
How does the Fed continue to be data dependent, though, Laura, when the data is about to be so strange? I was just looking at the survey for where jobs will be tomorrow. 101K is the median estimate. The lowest is a negative 10,000 by Bloomberg Intelligence. The highest comes from Steve Rasciuto of Mizuho, which is 180,000. Laura, how do we even begin to wrap our heads around the kind of number we're going to be getting tomorrow?
Well, I think it's largely anticipated that tomorrow's print is probably going to be more noise than signal. And if actually we look back to previous weather events, like in 2017, we had a trio of hurricanes. And in that context, Janet Yellen actually extended the Fed pause, but she noted that there's unlikely to be a material impact from the weather events over the economic growth over the medium term. So I suspect Chair Powell is going to take a very similar stance in the sense that, look, this is probably going to be a transitory hit. We're likely going to see jobs rebound over the coming kind of few months. But I think importantly, taking a step back, this is a jobs market that we do still think is kind of easing slowly. And that's largely because, job openings yesterday did suggest that openings are falling, quit rates are falling. So there is this kind of degree of labor market slack that is building. And that underpins our view that the Fed is still going to cut policy rates by 25 basis points at the next consecutive few meetings, all the way until June, when we get to that about 3.5% terminal rate.
Laura, thanks for setting it up for us. Always a pleasure to speak with you. Laura Cooper there of Nuveen. Let's get some of the other top stories trending on the terminal this morning. BNP Paribas posted third quarter results that got a trading boost. Performance of its stocks and fixed income business were strong, but its lending business, that continues to struggle. The French bank confirmed its targets for the full year, including a pledge to raise profit to more than 11.2 billion euros.
Siemens has agreed to buy the software maker Altair Engineering for $10 billion, furthering the German engineering giant's migration to higher margin software-driven product lines. The transaction, expected to close in the second half of next year, provides a 19% premium for Altair shareholders.
SocGen beat analyst estimates as investment bankers saw a 10% increase in equity trading, a 6% increase for fixed income. The results may provide a boost for the CEO, who has struggled for more than a year to win over investors with a strategy focused on capital strength.
Coming up, former President Trump adds another title to his resume, garbage truck driver. How the candidate is using Biden's comments to pick up momentum.
And we're going to get more on election risk. We're going to catch up with Mark McCormick of TD Securities later this hour. Stick for that conversation on why the difference between Trump and Harris is one of market focus versus data focus. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week.
More than what you need to know, it's what you need to think about.
Tuesday, election night is here. Trust Bloomberg for up-to-the-minute results as the races for the White House and Congress are decided, as well as detailed analysis of what it all means for the economy, markets, geopolitics, and more. Tune in at 5 p.m. Eastern for an extended balance of power leading into full team coverage at 7, live from the battleground states and Harris and Trump HQ. It's election night on Bloomberg. Context changes everything.
As President, I pledge to seek common ground and common sense solutions to the challenges you face. I am not looking to score political points. I am looking to make progress.
They treat you like garbage. They treat our whole country like garbage, with open borders, with all of the horrible things they've done to hurt our country, inflation that should have never happened, allowing Russia to go into Ukraine, October 7th, and Israel. All of these things would have never happened if you had a different president.
That was Vice President Harris and former President Trump making their final pitch to voters only 5 days to go until the election. Former President Trump, you could see him there in the high-vis jacket, using Biden's controversial garbage remark to his advantage by driving a garbage truck that carried his name in a vest. Joining us now is Bloomberg Government's Courtney Rosen. Courtney, we should just clarify the comments that Biden made, basically saying the only thing is that's garbage, referring to the whole joke about Puerto Rico that, let's be honest, was a very crude joke. The only thing that's garbage are Trump supporters. Biden team comes out and says, no, there's supposed to be an apostrophe on the S. He was talking about that one specific joke. Courtney, what does it just say at this point that we are down to the wire and you have someone like President Biden still coming out and giving gaffes? How did the candidates navigate these last couple days?
The next couple days, President Biden is going to be out there, but I'd expect him to be more scripted and more restrained, for lack of a better way to describe it. We're not expecting to see him today at the White House or out in public. Vice President Harris has tried to distance herself from those comments. President Trump, as you saw, making them, a media spectacle and a visual with that garbage truck. So I'd see in the next couple days this will continue to play out, but also we're not going to see the president as much.
Was the potency of the news cycle, and you got to say that they win at that. The one thing that we are perhaps most focused on is the risk of legal challenges, contested election. Look at what happened in Virginia. You've got a purging of the voter polls, but in Pennsylvania, again, there's been another legal challenge there. Run us through what that is and what it means for early voting, because their early voting is very different to everybody else's around the country, isn't it?
Yes, so early voting in Pennsylvania is not an option. People can mail in their ballot or they can go pick up a ballot to mail in, but it's not like they can go wait in the line, cast a ballot, and be done. In Pennsylvania, the Trump campaign had accused election officials of not allowing people to pick up a request form for a ballot. Now in the state, they're going to extend the mail-in ballot for an extra day as a result of that. I should say that across the country, mail-in ballots, early voting is extremely popular. When I checked the Associated Press this morning, they're at 58 million ballots already cast, and we haven't even hit Election Day yet. So these are high stakes, these early ballots, which is why you're going to see both campaigns focus on them heavily from a litigation perspective.
It's also been fascinating to see, Courtney, that the mail-in ballots that usually skew Democrat, they still are doing that, but more Republicans voting early too. How does that change the schedule from here? We know they're highly concentrated on the swing states. What's the message? What's the travel schedule like?
Vice President Harris is focused on hammering President Trump as chaotic, as divisive, and painting herself as stability and a solution to that. She's going to hit all 7 swing states in the next couple days. And in addition to that message, the message is go vote, right? If there's a choice between staying home and voting, she's trying to get people to go to the polls. We're going to see her in the next couple days out at rallies, out with celebrities, trying to really gin up enthusiasm. Now, former President Trump, he's also focused on encouraging people to vote early and just to do that as opposed to staying home, right? His message has been a lot more muddled in the final days, but it has focused on, when you put together the themes of the Biden-Harris administration has not been positive for voters, and that he would bring complete change to the way the U.S. government runs should he be elected.
Okay, well, certainly it's going to be interesting to see how it plays out with that early voting. I'm just looking at the New York Times. 54 million in North Carolina leads the pace in terms of early voting. Courtney, thank you very much. Courtney Rosen there of Bloomberg Government. Dollar yen is moving. We were checking this when we came in this morning. We've had the comments from Governor Ueda. It's on track. Look at that, Danny. You've got the dollar index. I mean, it is pacing ahead over the month. But dollar yen, this is dollar down, yen rising. Ueda, FX may have a major impact on the economy and prices, and he wants to judge the impact of a weak yen. So it's the rhetoric about probably reticence of where we are in this stage.
Yeah, and let's just take a listen to that.
We do not have preconceived ideas on the timing of the rate hike. Instead, the board will examine data available to us at each meeting and update our view on the economy and outlook in making our policy decision.
Ueda tying himself to the currency. And this I find really interesting. Standard Chartered says 160 is the level that would force their hand to hike. But you know what causes that? It's a Trump victory. It is a stronger dollar off the back of that, which could conversely charge the BOJ to hike. It just shows some of the reticence to do any moves now, because it's not just internal politics in Japan, which is playing out here, but it's American politics too.
And if you think about it, you know, we're going to have this conversation with Mark McCormick very, very shortly. What is it that has actually moved the dollar so far? It's about what has moved rates so far. It's no landing. What has moved the dollar so far, and we'll dig into this with Mark McCormick, it's about U.S. assets, the valuation of equities, and you don't want to kill the golden goose. So it's not just politics that's driving the dollar. It's the alpha of American assets.
Right. Something's going, they're going somewhere into American assets. Maybe not bonds recently, but, you know, stocks. Speaking of which,
there's a few others.
One stock that is in our focus, we're going to talk about Manus's coffee habits in the morning, Manus, and how long it takes him to order his double shot caramel macchiato with a twist, whatever.
Starbucks combinations.
We're going to dive into their new vision from the new CEO next.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Front pages from around the world look a little bit like this Thursday morning. Let's kick it off with the New York Times. Danny is emotional about this. The LA
I'm glad you're reading this, that's all I'm saying.
I was specifically told to read this. She can't take any more of it. The LA Dodgers defeated the Yankees. I've no skin in this game. Defeated the Yankees to win their 8th World Series. Los Angeles came back from a 5-run deficit to defeat New York. It's the 2nd World Series title for the Dodgers in just 5 years. I read that slowly.
I think I'm going to just move on from this and not give any comments.
You're right.
Yeah.
Rise above it.
Yeah, thank you. Thank you, Manis. Let's talk about China. Bloomberg has this. China's economy picking up on a stimulus push ahead of the U.S. election. Factory activity unexpectedly expanded in October, and they may be able to achieve their 5% target.
And let's round it off. Wall Street Journal leads with Starbucks pledging to keep the prices steady. Customers have been complaining about high prices and long waits. The chain adds had 3/4 of declining same-store sales. But Danny has a fact of the day
I do.
on Starbucks.
Well, part
fact
of what he
day.
wants to do is to trim back the kind of options you can have on just a latte alone, Manis.
Combinations?
Just a latte. 383 billion with a B possible combinations for ordering a latte at Starbucks.
The upside is this. You're going to be able to choose your own milk, your own sugar, and they're getting rid of those olive drinks.
Oh, I never tried them.
300, how many?
383 billion.
There's a figure.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger, alongside Manus Cranny. Let's set your agenda.
Tech disappoints. Microsoft drops on a slower growth outlook. Meta warns on AI losses. Apple, Amazon, Intel, all up next. Powered by the consumer, the U.S. expansion continues. PC and jobless claims on deck today. And we have 5 days to go, counting down to the U.S. election with candidates in their final stretch of the swing state tours.
It's a 3.5% drop for Meta pre-market. It's a 3.5% drop for Microsoft pre-market. That is why you're seeing the indexes fare so poorly today. It is the NASDAQ 100 futures leading us lower, down 1%. We also sold off yesterday, in part due to the pressure of higher yields. It was strong data across the board in Europe, in the US. In Europe, we're questioning 50 basis points. We had an ADP survey that was strong growth. 10s went above 4.3% for the first time since July. This morning, Manus, they are back below that, 4.29%, just barely. Today is a big day too. PCE inflation, Apple and Amazon after the bell.
And yet when you look at that bond board, you know, it's about disaggregating. What is it that's moved us to 4.3? Is it all the no landing, all the good data? Look at the reaction function in the ADP numbers and you begin to say, it's the data that's driving the yields. Well, what happens next if you do get a Trump presidency or even a red sweep? What is the musculature of those yields? Can they break 4.5? The options market is pricing in 4.5, which is only another 20 basis points. That is nothing on a red sweep.
It also begs the question, if it is a Harris victory, how much of it is even given back? If this is all due to economic strength, maybe we still are looking at 4.3% yields, even under a Harris win.
And maybe that's the asset differential. Maybe it is the equity market that has the drawdown. It's the bond market which remains priced evenly at the money for no landing.
I have to say, in sort of understanding the market reaction difference to Harris versus Trump, one of the smartest things I've read comes from Mark McCormick of TD Bank. This is what he writes. Quote, while a Trump is bullish for the dollar in the short term, a Harris victory doesn't spell doom for the US dollar. Indeed, inflation and growth drive the market rather than Harris, while Trump resets the market towards politics. Pleased to say that Mark joins us now. He's the global head of FX and EM strategy at TD Bank. Mark, I just love that as a setup, that the data is what drives market under Harris, and it is politics that drives markets under Trump. So how do you set up for that outcome?
Well, I think a piece of it is everything that happens in terms of event risk is always about positioning. Like this week, you know, obviously in FX, like it's not, you have to focus on its month end. So the dollar's had a really strong rally. U.S. assets about performed. So the dollar, I think, is largely selling off as a function of month end. And also, if you look at our positioning indicators, what we've seen is the market's kind of gravitated quite aggressively in a very short term period towards buying the dollar. I think so. We need to unpack like what would happen on the event, on liquidity, and what can happen in the months after. And I think the underlying piece of that story is, again, that we've been kind of hammering home that U.S. fundamentals are much better than Europe and Asia. We know that the market's getting Chinese stimulus, but again, the market can't focus on more than multiple themes at a time. So I think what's most important is the U.S. has a higher terminal rate. The market's repriced a higher terminal rate. U.S. data, you know, in a world of data dependence, is better than most other places around the world, and the market's recognizing that. And I think regardless of who wins, Harris or Trump, again, we will have a positioned event and we will have to pay potentially unwind Trump hedges if Harris wins, but that does not set the landscape for what can happen in the aftermath.
Well, let's just break down some of the events. Mark, good to see you this morning. Looking at G10 over the past month, all currencies are lower against the dollar in G10. And the worst performing is, of course, the yen. When you break it down, and again, we asked you the same question we asked the bond guest a little bit earlier, you would say the dollar's drive higher is on the valuation of dollar assets rather than politics. So if you do get a red sweep and or a Trump presidency and a split Congress, is there much more flex in the dollar from here? Can it be a much more vicious leg higher on that construct?
Absolutely. I think we're not seeing really, I would say, a lot of Trump trades. I'd say market positioning's moved in the favor of the dollar, largely as a function of a couple things working together. Again, while we're kind of hammering home the idea through the summer that U.S. data is better. So that's a good thing. We've been hammering home the idea that we need more macro volatility. We're seeing that happen as well. And again, at the same time, we just said the market, as much as we've all spent this entire year talking about this election, no one was actually trading it. So we've moved on from the focus on the U.S. data was slowing and we had to reprice the Fed. That theme has been absolutely disrupted by the data, but now the market is actually looking at good U.S. data in conjunction with what is polls and betting markets and the data that we can all track on the election, that it's moving more in favor of Trump. So just at the very least, you have to price in the risk reward of tariff potential, of uncertainty, of a potential shift on the Fed, because everything Trump proposes, especially for a red wave, is inflationary. And inflation is another thing that's been catching the market off guard. Is for the whole year, we've been focused on different themes. And I feel like what the market's moving back towards, this is why we're seeing the bear steepening U.S. curve, is inflation is not dead. We are dealing with inflation that's sitting above most central banks' targets. And most of the world has easy monetary policy and easy fiscal policy. So again, the red sweep to me is absolutely not priced in whatsoever. You could see the dollar move another 3-4% higher across the board because the market's going to have to reconsider how much the Fed could move and also how the whole world would essentially kind of operate in a new uncertain environment.
Mark, what do you then make of calls like that from Adam Posen of the Peterson Institute, that if there is a Trump presidency, a red sweep, not only does inflation remain sticky, but it's an environment where we're going to start talking about hikes again in 2025?
Absolutely. If you just go through the kind of the context of 2024, it was tons of Fed cuts priced in, Fed cuts priced out. We did talk about hikes for, a couple weeks earlier in the year, and then that was kind of reversed again, and we got back to cuts, and now we're basically pulling the cuts out. I think it's very interesting in the context of stuff that we talked about in our research. We run these portfolios, we run these factors to help us understand what's going on in the FX market. And the story that we've been saying all year is mean reversion is king. Macro factors like growth and inflation are not working as trading strategies in FX because we don't know exactly what data dependence means. We know that a month of data or 2 months of data on negative growth surprises gets us focused on cuts. But now we're starting to see inflation indicators start to creep up. We're seeing higher inflation surprises, which pushes us back towards inflation. So I think that's absolutely right. But you can look at every country around the world. Japan is a perfect example. Japan is still going to pursue further fiscal stimulus, which is going to force the BOJ to hike more. You can see in Britain's budget, it's more fiscal spending. You can see it across the board that, half the world has gone to vote this year. And the outcome is politicians are looking for ways to boost fiscal stimulus. We have not left aggressive monetary and fiscal stimulus policies since the pandemic. They're all both basically coordinated at this point. So I would absolutely agree that the thing we should be worried about is not downside to growth, it's upside to inflation.
And that upside to inflation is something that could have a real impact on the Fed here in 2025. We've had Torsten Slok talking about the potential for no cuts and maybe even a reversal for the Fed going into 2025. But I want to go back to your comment on the complacency about macro volatility. Look at credit spreads, tight as can be, all-time highs just often in the equity markets. Bond vol, Danny was touching on this yesterday, is rising. So where are we most complacent, or what are you most concerned about?
I would say macro vol is kind of a composite of the VIX, global FX volatility, and something like the move. That's an indicator that we run as a composite. We compare that to geopolitical uncertainty. We compare that to a risk premium that we use that looks at cross assets. So I would say it's that. And I'd say it's that because that's an indicator that we look at for the carry trade. And I think one of the big stories of 2024, and I think this is going to carry over to 2025, is whether or not the best performing strategy that's usually in everyone's toolbox for FX, which is carry, whether or not that's a viable strategy for next year. It's something that we've pushed against, again, which is why we're bullish the yen, which is also why I think, this could be another conversation, maybe after the election, but regardless of who wins, you could actually potentially think of a bullish environment for Asia assets, even if Trump wins and tries to push a tariff agenda. The one thing that I would highlight here is that, the higher macro vol that we kind of keep seeing, either as a function of geopolitical or data or markets repricing central banks, it continues to undermine carry because what we're seeing is rate differentials are compressing and we're getting hit by higher volatility. And that's continuing to see a strategy that's fundamentally not that sophisticated. Carry is basically you buy assets with higher yielding yields and then hope that volatility doesn't rise. I think what we're seeing here is a rotation out of that, and we'll continue to see that into 2025.
Okay, there's a huge amount of uncertainty between over the next 5 days, and indeed beyond that, as you said, the dollar can continue to rally. Mark, thank you very much. Mark McCormick, TD Bank. Let's just check out on the bond markets. We had a massive budget yesterday in the United Kingdom. Danny, what you hear is another spike in the very short end of the curve. Figures from the Debt Management Office show that debt sales were likely to reach £300 billion in the current fiscal quarter. So that's up from 278. So the short end, and indeed across the curve, spiking.
A market that's willing to punish the UK, will it be willing to punish the US in a similar fashion? This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the party. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Brief, I'm Managed Training alongside Danny Berger in New York. The Mag 7, you're waking up this morning to a very different market. Microsoft and Meta earnings after the strong results from Alphabet 24 hours earlier. Let's discuss the differential of 24 hours with Richard Clode, portfolio manager at Janus Henderson. Good to have you with us. Here we go. 24 hours ago, we were flexing on fire. Alphabet was delivering AI, productivity gains, usage, coding. This morning, we are so much more restrained on Microsoft and Meta. What is the differential here? Is it the starting point of Alphabet or the underwhelming numbers, perhaps in some areas, from Meta and Microsoft?
Yeah, exactly. I think near term is just expectations and positioning relatively within the Mag 7, which is why I don't you can ever look at them as a monolith. But if you take a step back, I think actually there's just a lot of commonality between many of those businesses that very large scale platforms are delivering 15 to 20% organic growth with expanding margins, and even with massive capex still generating a lot of free cash flow and shareholder return. So starting to see those returns on that AI capex, but that debate's just not going to go away anytime soon.
The margins, though, do seem as a sticking point, Richard, because for now, Microsoft and Meta showed yesterday that part of what they're able to squeeze out are cost cuts. I know the FT had reported that Meta was restructuring certain teams with that sort of aim. How long can they continue to do that to preserve margins by cost cuts versus more monetization of the AI products they're putting out?
Well, it's a bit of both, isn't it? You're trying to monetize products externally, but then you're also leveraging this AI technology internally. So, as we heard from Google, 25% of coding is now done by Gen AI. We've seen that at Microsoft, we're seeing that at Meta. The ad generation, 15 million Gen AI ads, and they're seeing better throughput and click-through rates on those as well. So you're seeing both. I think internally they're using this technology and externally. And so you can optimize your business in terms of headcount because you are seeing those productivity gains from this new technology.
When it comes to Microsoft, perhaps one of the more alarming things was from the CFO. She talked about a limited capacity, limiting their capacity and their ability to deliver. They are constrained by their data center build out. Now, the risk to the market is that they run headlong into more and more capex to deliver on that. How much of a restraint or how much of a holdback will that narrative be from the CFO?
Well, that's what the market's got to decide. Which one is it? Are we worried that they're supply constrained, or are we worried they're going to spend too much on capex? And I think this tension in the market just isn't going to go away. And there's always just a timing issue. The capex spend comes first. You train up that large language model, you create some new product or service, and then you go to market and you're going to monetize it. And there's just going to be, in some cases, years between the two. And so the market's just got to keep comfortable that the spending is in proportion to the opportunity in the future. And that's why all these companies are now giving us a lot of these milestones to make us feel comfortable that they're seeing the benefits internally and then also ramping up these businesses. So Microsoft also said, they've hit $10 billion of AI sales, and that's the fastest that they've ever got to $10 billion in a new product or a new technology.
Richard, I love this idea that the companies are kind of hand-holding us, saying, okay, we're getting there. We're going to get to these different AI milestones. It's okay. You're going to be all right on the journey. How successful do you think Apple has been at that? We're going to get their earnings today. They've released some of their Apple Intelligence features. Have they held our hands, and are we going to be okay?
Yeah, so that's another one where I think it's going to be a journey. I think, we've only just started to see some of those Apple Intelligence features come through into iOS, and that's only in US English, that's only in certain geographies. So, I was never a believer that this was going to drive a major replacement cycle in this iPhone cycle, but I think we're rapidly going to move forward into thinking about, what's going to happen next year and beyond that. And their vision of, that Siri is your gateway into Gen AI is a very interesting proposition to keep their fundamental positioning and competitive moat in a Gen AI world. But we've got to see how that's going to play out, because Meta's telling you, actually, no, we want Meta's apps to be your way to engage with AI agents, and we don't want to be disintermediated by Siri or by Apple. And again, that tension as to who's going to own the top of the funnel into a Gen AI world is going to determine ultimately who's going to be the most successful in this business.
Well, when you look through the narrative, it was about AI productivity gains in Alphabet. It's about spending a little bit more time on Facebook and Instagram and generating adverts. So if we cast forward then to Amazon today, what is it that you're going to be looking for from an AI perspective from Amazon?
So we've always seen the cloud platforms as a delivery mechanism for this new technology. I think all companies are coming to terms with actually only 20% of workloads are in the cloud. And why didn't they shift? Well, they didn't shift because it takes time, it's costly, it's painful. But then Gen AI and sort of trying to create the strategy for where you see your company in the future, that data architecture now has to move to the cloud. You're going to be leveraging AI, large language models and services from these companies. So that cloud platform growth, we're seeing accelerate across the board. And we'd like to see that from Amazon too. You've seen that from GCP, you've You've seen that from Azure. We'd expect to see that from Amazon as well. And then we'd like to see them be a bit more front foot. You know, they've got the capabilities. They've been designing the silicon for years, but they've just been a little bit back foot in terms of positioning and probably lost a little bit of mind share to the Azures and OpenAIs of this world. We'd like to see them get a lot more front foot, and I think that's why you've seen some of the management changes that you have at the company.
Richard, one of the things that I'm getting from you, especially with this idea of Meta saying, we don't want you using Siri, we want you to use our own agent, are these companies treating AI and the future of generative AI as a zero-sum game, almost a prisoner's dilemma of who can outspend who kind of blinks first and goes full on in. Is this how it's going to be? Is it a winner takes, maybe not all, but most future for AI?
Well, I think on the one hand, you're seeing that no one wants to get off the train because the risk of underinvesting is certainly much greater than overinvesting, so that's a risk. But I think the thing we all miss with these new technologies is that the addressable markets end up being much bigger. So, you know, rewind a year or 18 months and everyone was worried about Google search and it being disintermediated. We're going to add more Google search dollars this year than we have done in any of the prior 5 years, because actually contextual search is actually greater utility to us. And so we're doing more searches. And so they've got a billion AI overviews and they're monetizing just as well as a traditional search. And so I think we're going to see that these markets will end up being a lot bigger. We've already seen that with NVIDIA, that actually your data center business can be multiple times what we saw in the cloud world for an Intel. I think we'll see that at a lot of new markets. They're just going to end up being a lot bigger. And so it's not going to be a zero-sum game because the game just got a hell of a lot bigger.
It's a bigger pie. Richard, wonderful to have you on. Thanks so much for joining us. Richard Claude of Janus Henderson. Okay, more earnings on deck this morning. ConocoPhillips, they are set to report before the market open. Then we're going to get Chevron and Exxon tomorrow. It is the big oil come to play. James Herron joins us now. James, set the scene for us. What are we expecting?
Well, it's going to be a weaker quarter overall just because the backdrop of oil markets, it was down very much in the third quarter, both crude prices and margins on refining fuel. I think the key to look for really is resilience in two ways. It's balance sheet resilience, like to what extent can the companies maintain their buybacks, dividends, these really generous investor returns they've been having for the last few years. So look for signs of rising debt, putting pressure on it. We've seen that a bit in the European companies so far, and also resilience in terms of natural gas has been a big thing. The gas markets have been doing a bit better than oil markets, and the companies that have bigger gas businesses have, again, in Europe, proved to be a bit more resilient to the weaker overall energy markets. So I think that's the things to look out for when we see Conoco and today and then Exxon and Chevron tomorrow.
James, good to see you this morning. We've had Shell and Total this morning. I look at the Shell numbers. Again, really impressive on the buyback, $3.5 billion over the next 3 months. I look at Total a little bit lighter. How important is the buyback in this narrative in the European market relative to, let's say, deregulation here in the United States, which is a political issue?
It's very important. Investors have doubts about the long-term viability of oil companies and their growth potential, particularly because of climate change and net zero. So the buybacks have been a major way of wooing investors. But obviously, as we now move into a period of lower energy prices, can companies, do they have the balance sheet strength to maintain these buybacks? Now, we saw on Tuesday, BP, its net debt rose a bit in the third quarter, and it raised the possibility that it's going to review its buyback policy in February, and it might change. A lot of analysts predict that it will be a lower buyback. And then their shares fell 5% on the day of earnings. Whereas Shell came out today, it's stuck to its buyback plan. Its gearing actually dropped again this quarter, even though the oil prices were weaker. And it's saying that its balance sheet is strong enough where it can really just withstand a weaker macroeconomic picture but maintain investor returns. And I think that's key, really.
Okay, James, thank you very much. Filling us in there on the very latest from the oil market. Coming up, Danny and I'll set you up for the rest of your trading day. We've got a nice clip of economic data, and of course, a few more earnings to run through. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
It's your Bloomberg brief on this Thursday. Danny Berger and Manus Cranny in New York. Let's get you set up for your trading day. Earnings are going to come. ConocoPhillips, Uber, MasterCard, all those report before the bell. We're also going to get core PCE, personal income and spending, and jobless claims, 8:30 a.m. Eastern for that. And Manus, we're going to get more big tech, Apple, Amazon, Intel. Those all come after the market close.
We're going to be drenched with macro and micro. Let me take you through a couple of moves here. You've got MicroStrategy moving towards raising $42 billion for Bitcoin. Booking holdings, third quarter, gross bookings there, beat estimates, and they raised their forecast. But brutal day out for Roku on the streaming service. Forecast miss the estimates, and they're going to stop reporting quarterly user numbers, and that is a brutal drop, down 14%. Danny.
Speaking of tough drops, both Meta and Microsoft falling in the pre-market session. Is this investors finally antsy about high valuations? If you point to one difference between them and Google, it is that Google is coming from a much cheaper place, so maybe the bar is just different for these companies.
I think the narrative that Alphabet managed to sell to the market yesterday very, very clearly, which was about the productivity gains from the AI. I mean, there's a number of lovely one-liners. The constraint that Microsoft has said that they have in terms of their data centers is probably one of the biggest concerns. You'll get more tech in surveillance. We'll be back tomorrow.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, you know, with lots of supporters, a really mind-blowing level of innovation against emissions. And, you know, in the last 9 years, that's gone better than I would have expected. So only now could you even, you know, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up very like this speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Betting markets have gotten way ahead of themselves. This is still a toss-up.
There's a lot of concern that a Trump administration would mean more inflation.
Trying to understand what's a press release, what's a meme, and what is actually implementable remains a big question.
Both parties have platforms to stimulate the economy.
Many of the big issues facing this country are going to be facing us no matter who takes charge.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with equity futures on the S&P 500 pulling back here across the board. We're still poised just about for a 6th month of gains on the S&P 500, the longest monthly winning streak going back to 2021. Look out below on the NASDAQ 100. We're down by more than 1 full percentage point. Two names to watch in the pre-market. One is Microsoft, the other is Meta. Just a little bit lighter on cloud revenue over at Microsoft. Lisa, that name down 4%.
Yeah, the expectation also coming in just a touch. A key question for me, is this capacity or is this demand? What we heard from the CFO was that this really has to do with just limited capacity to fulfill on some of the AI bets. That's a short-term issue if they can get those chips. The question is, are we seeing Google take on a greater share of the business as they seem to have more capacity?
It's so interesting that these stocks are down this morning because actually the quarter was good. Microsoft revenue was up. Cloud computing, revenue up. The signal that it's going to be slowing down, also how much more both these companies are going to have to spend, that capital expenditure on AI. But it's the reason, because of AI, that this entire year, those stocks were flying high.
Well, let's talk about the CapEx spend. This is over at Microsoft. Quarterly CapEx, almost $15 billion, a record, up 50% from the same period last year, and they're going to keep on spending into 25.
So we talked about how are we seeing investors push back against increased spending? Is this going to be a problem? But I'd flip the script just a touch and say if you can show the money from it, they're going to be okay with it. It's not a big deal. Question is, are you showing the money with it? Microsoft, Facebook, Meta, not so much. And that, I think, is the big issue. Is there a fear that Mark Zuckerberg is going to go back to the Mark Zuckerberg of yore before the efficiency moment and really go back to spending even while burning cash at a pretty fast clip in certain businesses?
Meta is down by a little more than 3%. Let's talk about the bond market as well. 2-year, 10-year, 30-year. Yields are coming in just a little bit. We're down a basis point on 10s, likewise on 2s. On the month, though, the 2-year and 10-year yield up by around 50 basis points apiece. The conversation that has dominated everything we've talked about around this table now for the last 4 weeks. Is it the economic data or the politics? And if it's the politics, there seems to be, I would say, some divergence between the conversation on Wall Street, which is Trump trade, and what you're hearing from the pollsters, which is this race is still really, really tight.
And then people will say, well, then it's the economy, and that's what's really affecting yields, which you do see right now. Yesterday, I've been looking at the Trump media and technology stock, and that's sort of the best, sort of cleanest view. And yesterday it tanked 22%, although it's up something like 300% so far this year. There's a key question: how much one poll or another could shift betting odds that seem to have a very clear answer. Honestly, I'm not getting a clear answer from anybody on how much you can really dissect the different features into the bond market.
CNN yesterday had a brand new blue wall where Michigan, Harris is up, Wisconsin, Harris is up, but all of this is in the margin error. Pennsylvania is where they're tied. Fox News comes out with their battleground poll. Pennsylvania is where they're tied. And if you look at some of the research that's done by Oxford Economics, where inflation hurts the most is in a place like Pennsylvania. This stood out for me. Every 1 percentage point increase in inflation before a presidential election is linked to tens of thousands of Pennsylvanians voting against the incumbent and for the challenger. This state is so important, and right now it's on a knife's edge.
There's a huge week coming up for financial markets worldwide. Tomorrow morning, payrolls. Next week on Tuesday, the election in America. Then 2 days later, a week today, a Federal Reserve decision at the FOMC looking to reduce interest rates by 25 basis points. Coming up this hour, we'll catch up with Lori Calvasina of RBC on a disappointing earnings season. We'll speak to Heidi Kribo-Redeker of the Council on Foreign Relations on the fallout from Biden's garbage comment, and Stefan Slowinski of BNP Paribas Exane as Amazon and Apple prepare to report results. We begin this hour with disappointing tech earnings weighing on stocks, Meta warning of more AI losses, and Microsoft predicting slower cloud business growth. Lori Calvasina of RBC with this to say: the early S&P 500 stats are now pointing to a mildly disappointing third quarter reporting season so far. General discussions of the outlook, macro backdrop and business conditions remain mixed, as has been the case throughout 2024. Lori joins us now for more. Lori, good morning.
Thanks for having me.
What a week we've got coming up. Let's start with these earnings. What do you make of what we've heard from tech so far?
Look, you know, at the beginning of the week, right, I felt like maybe it could be a little bit better than what we heard last week. And I just came out of last week saying, you know, and I actually felt really good on week one post the financials. And then, you know, I kind of felt like I got beaten down. And we're broadening out this week. But I think the issue is, right, coming into this week, there's been a lot of nervousness on this AI story, right? And if I think back to last week, I wasn't getting a whole lot of AI commentary in the transcripts I was reading through. So it felt like maybe this is the first big week that we're going to get, you know, some real meaningful insight. And investors obviously aren't liking what they're hearing out of the gate.
If I'm company X and I turn around and say I'm constrained by capacity, is that a good problem to have?
I don't know, to be honest. I think the issue with this AI trade, right, is that it's just very, very messy. And investors are worried about overbuild. So they're kind of like looking at the long term and the short term. And the short term, it doesn't sound like is satisfying anybody right now. And the longer term, I think, is a little bit unclear. And if I think back to sort of all the customers of these big cap tech companies, right, kind of the end users of AI, that's where things are getting very messy. And I've characterized this in my meetings. If you look at some of the end use cases, and we're starting to get more of those these last couple reporting season. Some of them, you know, I read like business services companies, really data intensive companies, and I say, okay, you know, they're doing some stuff here. Other companies, you know, I'm hearing about catalogs. You know, all in all, it's feeling a little small potatoes to me, and I think that may be part of the problem.
So one of the reasons why I love speaking with you is because you do analyze all the transcripts from earnings calls to get that kind of guidance.
Yeah.
How much was AI mentioned versus previous earnings cycles so far?
So I don't have good stats yet on October. We like to run the stats on a quarterly basis. It does get very lumpy month to month, but we actually use the Bloomberg, you know, transcript tool to measure this. And coming into this, when we crunched the numbers through September, if you looked at it on a quarterly basis, we were still at extremely elevated levels on AI discussion. It actually looked kind of like the chart we ran on the Fed and interest rates, where it had just gapped up and sort of plateaued. And so we weren't seeing any kind of like big drop off, any big surge, but it was just sort of maintaining steady at very high levels.
The reason why I ask is because I think what you mentioned is really important here, which is companies are in the same place that investors are in.
Yeah.
Show me the money, show the efficacy, and how much is it really sort of how effective these AI tools are that's going to determine the fate of the stock. And I'm thinking with an eye toward Apple, which is going to report after the bell today.
And let me give you just some additional context. So if you look at S&P 500 bottom-up consensus forecasts, they've actually come down a little bit in recent weeks, but normally they don't do much in the second half of the calendar year. They basically, you know, we've done this study, you go to the summer of the prior year, they get worked down. They get worked down in the first half of the year in question, and by the time you get to like June, July, they're set. And we haven't had that in this cycle. They've been pretty similar to where they were last summer. There's a lot of stability, and so now we're starting to see them nudge down a little bit, and it feels like maybe we're getting some pent-up downward revisions that we should have already had. And you know, that's not speaking to any one specific company, right? But these big mega cap tech, you know, AI secular growth names are big contributors to that, right? So I just feel like maybe we're just catching up to something we should have done already.
Lori, how much of the commentary is focused on the U.S. election, and are people still staring into the sun?
I actually feel like I need to be looking for my eclipse glasses right now. You know, we need something a little bit stronger than sunglasses, but we ran a similar analysis just looking at the quantitative trend, and we saw a spike in the last couple quarters on election commentary. We certainly felt that in our transcripts. I will give you a little bit of comfort in that it was on par with what we saw in late 2016 and late 2020, so it's no more than usual. But the element of uncertainty is enormous, and that's what we keep seeing companies talk about both this and last reporting season, that the uncertainty is just huge. It's weighing on business activity. We're even seeing some consumer companies starting to talk about that.
A few months ago, you put in your note that you actually see some credence in the fact that there is a Trump trade developing. Do you still see that?
So we saw that back in the fall, and that kind of disappeared, and now we're starting to see it again. And so I've been getting a lot of questions the last week or two, like how much Trump is in the market, right? How much of it's baked in? People are trying to put percentages on this, and I don't think you can do that. If I think about my clients, so I'll give you qualitative and quantitative. The qualitative is that when I talk to long-only investors, they are confused about what is going to happen on Tuesday. They are confused about what to do once they do know who the winner is. And they are talking, but they are not doing much. They are trading on earnings, but they're not really trading on the election. Now, that's long-onlys, mutual funds, portfolio managers, hedge funds. I'm not quite as sure. I am starting to see questions come in where people are trying to gauge, in the different scenarios, what's the S&P 500 going to do? So it is starting. If I think about it quantitatively, small caps, the dollar, 10-year yields, we are all starting to see very close correlations between either polling data or betting data, specifically looking at Trump and those assets. And I can't sit here and tell you that's the only thing driving those, but I am seeing enough in the data to know that somebody somewhere is moving something. I don't think it's everybody. I don't think it's widespread. I think it's kind of a thin market, and it's getting pushed around.
So we've got to consider the balance of risk into next week. Do you think we're vulnerable to an unwind? As you look at some of these trades, you've mentioned a few of them, this whole long dollar, short bonds, long US equities versus the rest of the world. Do you think we're vulnerable to an unwind? Or are there enough tailwinds beyond politics to support those trades?
I think it depends on your time horizon, and I think it depends on the specific setup that we have. I mean, Lisa was talking about betting markets earlier. Those betting markets are not all uniform. So I'm going to brag about you guys. You have this fantastic page, WSL Election Go. You can track all the different betting markets, and you're not seeing the same thing in predicted and poly market right now. So you're actually starting to see the data shift back towards Harris and the predicted data. You're not seeing that in poly market. So I don't know what is going to happen over the next 5 days. I do know that traders are queuing off those betting markets, regardless of whether or not you think they're useful outcome predictors. I do think, though, if we sort of keep where we are and we end up having a Harris win, I do think you're going to see some of this stuff unwind. Now, longer term, what does that mean? We did a survey of our analysts in late September, so we're not baking every single policy crumb in there because a few more things have come out. But we asked our analysts, gauge the outlook to your industry under these 4 different outlook scenarios. So the 2 sweeps and the winners with a split. And it was interesting because when I averaged all their scores together, they were basically hovering around neutral. There were tilts, so Trump had a little bit of a bullish bias. I think it was like 0.38. Very bullish on my scaling would have been +2. Bullish would have been +1. 0 was neutral or mixed. The Harris win with a split Congress was -0.04. Right smack dab on neutral. So, when I talk to investors, they struggle with things on the Trump side. And again, this is the long-only crowd. Corporate tax cuts are good. Individual extending those tax cuts are good. Tariffs are bad. And I think the conflicting cross currents really is at the heart of what has the longer-term investors confused right now.
There's an idea that's gotten a lot of popularity, which is that the bond market is being moved around much more than the stock market. Do you agree with that that's really going to be the node of volatility post-election? Well,
I'll tell you, I'm an equity person, not a fixed income person, and I always joke I don't speak bond market well. But the reality is that, I've got like 4 charts in my deck, right, that are looking at these correlations right now, and we really just focused on the time period after Harris came in. The cleanest, tightest correlation that's been going on for the longest period of time is the one between Trump and the 10-year yield.
Laurie, appreciate your time. We're watching the same things, looking ahead to next week with dread. For many reasons. Laurie Calvasina of RBC. One of the big reasons is this could be a very, very long week next week, and it might spill into the following week as well. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Just wanted to give you some specifics on those big tech earnings. Microsoft falling nearly 4% in the pre-market trade. Earnings and revenue beat estimates, but it did forecast slower quarterly cloud revenue growth. Microsoft is struggling to bring data centers online fast enough to keep up with demand for AI services. CEO Satya Nadella reiterated that he is committed to expanding AI opportunities and winning new customers. Meta shares, those also lower pre-market, 4%, despite a narrow earnings beat. Chief Executive Mark Zuckerberg said that it will ramp up heavy investments in AI and other futuristic technologies, which he says are core to the company's future. Meta cautioned that its losses from the AI division, Reality Labs, that will continue to widen this year. Reality Labs reported a $4.4 billion operating loss in the quarter. The LA Dodgers are world champions once again. After falling behind 5-0 in Game 5, a series of defensive mistakes by the Yankees opened the door for an LA comeback. The Dodgers plated the winning runs in the 8th innings and sealed the championship with a game-ending strikeout. It's LA's 8th World Series ring and the first for superstar Shohei Ohtani in his first season with the team. Freddie Freeman was named Series MVP after a record-breaking performance at the plate. And that's your brief, John.
Danny, world champions. Is that what we say?
That's Canada, too. It's the world.
World champions. Is that what we really say about this?
I guess the Dodgers won. Look, I went to bed and the Yankees were winning 5-0. I slept so well, and then I woke up to this terrible news. What happened?
America and a little piece of Canada. The World
And a lot
Series.
of viewers in Japan.
Very true. Truly global. Up next on the program, reclaiming the garbage narrative.
Joe Biden's comments were the direct result of Kamala's decision to portray everyone who isn't voting for her, which is a lot of people, as evil and subhuman.
That conversation up next. Live from New York City this morning. Good morning.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
The longest week of the year begins tomorrow. Payrolls just around the corner. Then it's on to the election in America, and after that, a Federal Reserve decision. And hopefully, we have a result from that election, and this market can trade with some clarity on the outlook for 2025. Equity futures on the S&P down by 0.8% as tech earnings come in a little bit softer. Bond yields are lower by 2 basis points. The 10-year 427.63. Later this morning, some jobless claims data. Under surveillance this morning, reclaiming the garbage narrative.
Joe Biden's comments were the direct result of Kamala's decision to portray everyone who isn't voting for her, which is a lot of people, as evil and subhuman. They treat our whole country like garbage.
Here's the latest this morning. Donald Trump leaning into President Biden's garbage remarks. Meanwhile, Kamala Harris distancing herself from the president's comments.
Let me be clear. I strongly disagree with any criticism of people based on who they vote for.
Heidi Kripo, Rediker of the Council on Foreign Relations, writing, final days come down to turnout. Does the floating island of garbage insult remind Puerto Rican voters in swing states of Trump's poor treatment of the island after Hurricane Maria? Seeing massive backlash, but will they vote on it? This could make or break the election. Heidi joins us now for more. Heidi, just elaborate on that. Your thoughts on the last few days, this word garbage, and how it may shake up this election race.
So I'm paying a lot less attention to the Trump comments on garbage than what happened at Madison Square Garden on the floating island of garbage comments. And I think the reason that I'm thinking that is because right now it really does come down to turnout. The polls are razor thin in the states that matter, in the communities that matter. And so if you're undecided and you haven't voted yet, what's going to make you decide? If you're ambivalent and you are, you need an actual reason to vote, is what Trump's talking about going to actually, turn the dial for you? Because I think his supporters are pretty, they're pretty committed, and if they haven't voted already, they're probably going to vote for him regardless of the garbage comment. For the Puerto Rican community, I think it's really a wild card. That's what I'm paying attention to, because that comment at the event at Madison Square Garden, even though Trump did not make it himself, he never apologized for it, and it insulted and reminded Puerto Rican voters in swing states of Trump's poor treatment of the island after Hurricane Maria, about the way he delayed aid, and then when he got there 2 weeks after a devastating hurricane, he threw a bunch of paper towels at the crowd. And so, it's a question of whether or not these very large Puerto Rican, specifically, populations in these swing states, Anne Marie was talking about in Pennsylvania. 500,000 Puerto Ricans live in Pennsylvania, in a state that Joe Biden, when he won last time, it was on 80,000 votes. So, we're talking about very large numbers who could decide they're really not very happy about what they saw more than 4 years ago in the treatment of Puerto Ricans. It was insulting, and it could move the dial.
Heidi, of course, the flip side of this is a large part of individuals can also be turned off on the President of the United States comments that half of Trump supporters are, quote, garbage. And Kamala Harris is now having to clean up Joe Biden's comments. Is he doing more damage to her every time he goes out and speaks?
So I think that it was unfortunate that he used that language, and it obviously harkened back to comments that were made during the campaign with Trump and with Hillary Clinton. So but again, if you are going to, it's really about a narrow swath of voters and what can motivate them to change their decision. Or if they are turned off of politics and just want to sit this election out, what can make them actually get up out of their house and actually cast that vote? And I don't know if President Biden's comments, which we're not reelecting President Biden, if they actually are going to move the dial for that very important group of undecided or ambivalent voters.
Heidi, how do you think she sticks the landing when it comes to the economy? The FT this morning calls Kamala Harris's other electoral foe inflation. This continuously shows up in polls. How does she distance herself in these final days in these swing states from the current administration when it comes to inflation?
So it's a hard narrative. I mean, people are generally hurting from the fact that that goods, the everyday goods cost more than they did pre-COVID. I guess what I would suggest is that it's not just looking back over the last 4 years. It's looking forward to what a blanket tariff policy across all the whole world of 10 to 20% and 60% on China, what that actually could mean for inflation. Well, it's probably those kind of tariffs are inflationary. Tariffs we've had for many years. We know what they do. They're inflationary, and it depends if they are tactical and targeted versus across the board. I don't think that voters really understand that Trump saying that he is tariff man can get into the Oval Office day one and actually, without any checks and balance, he can actually implement his across the board tariff policy that would be inflationary. And what does that mean? It means that it's going to impact consumers, intermediate inputs, like for every business that's part of a supply chain. You can count on retaliation. You'll blow up all of our FTAs with countries, and our allies will push back pretty heartily against us in a world where we actually need our allies. We don't need to alienate our allies. So I think that there are, it's not only inflation, but you could have both, commercial inflation and geopolitical reactions that would be highly negative. What does the Fed do? We're talking about the Fed for next week. What does the Fed do if they're facing, challenges to inflation on one side, and then spillovers that might impact credit markets, mortgages, company borrowing? You're going to be in a very different dynamic if we come January and you have massive across-the-board tariffs imposed.
Heidi, what are you watching in the final days of the election race?
So, again, the markets are not a good predictor of who's going to be in this election, who's going to win this election. But I do think that the fact that you've had a lot of women show up in early voting, you've had, and the gender divide plays very much into Harris's camp. The fact that you do have these narrow populations who can actually, really determine the election one way or the other, and we just don't know. Anyone who tells you they know who's going to win doesn't know what they're talking about. We are neck and neck right now, and we're not going to know until the votes are finally counted, and that might not be next Tuesday, might not be next week.
Don't say that, Heidi. I'm hoping it's all over by then. Heidi, appreciate your time, as always. Heidi Kribo-Redeker there of the Council on Foreign Relations. Just on tariffs, we'll catch up with Seth Carpenter at Morgan Stanley a little bit later this morning. Seth believes that those tariffs, implemented as proposed on the campaign trail, would lead to slightly higher inflation, slightly lower growth, so some stagflationary wins there for this market to deal with, potentially, and of course, potentially is doing a lot of heavy lifting whenever we talk about this stuff. Equity futures right now on the S&P 500, negative by 0.8%. Tech weighing on this market this morning. We'll hear from Stefan Slawinski of BNP Paribas Axan following disappointing results from both Meta and Microsoft. That conversation up next.
think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Equity futures down 0.8%. Check out the Nasdaq 100 down by 1 full percentage point. Tech weighing on this market this morning. We'll have more on those earnings in just a moment. But let's just take stock of the month so far. The S&P 500 heading towards 6 months of gains, the longest winning streak going back to 2021. Utilities have been a major winner of the year so far. They've had a difficult month, and here's the why. Get to the bond market board. 2-year, 10-year, 30-year. A move of almost 50 basis points in and around on both a 2-year and a 10-year on the month so far. 416 on 2s. On 10s, we're down 3 basis points on a session, 427. That's been the big surprise of October.
And it's come with both the political potential overlay as well as the economic data. The Citi U.S. Economic Surprise Index now at the highest level, continuing to climb. It's the highest going back to April. Yesterday, that jobs report from ADP. Normally, we dismiss ADP unless it's particularly remarkable, and then everybody points to it, really highlighting quite a bit of strength just confirmed by the GDP report today. What happens if we get core PCE that also comes in hotter than expected, the key metric the Federal Reserve looks at for inflation?
ADP's not flying solo. It's reinforced by the Conference Board consumer confidence as well, by jobless claims over the last weeks too. Jobless claims again in about 2 hours' time, so look out for that. Big question in the bond market in America, do deficits matter? In the UK, apparently they do. Look at this move, 2-year, 10-year, 30-year. Over in the United Kingdom, the 2-year higher by, let's call it 8 basis points, the 10-year up by 5. This is what the debt management officer's got to say. It's going to sell 297 billion sterling of government bonds this fiscal year. That's the second biggest target on record, widely expected. This is what we're thinking about coming off the back of the budget. Investors all pointing to the official projections that imply around an extra 142 billion sterling of borrowing over the next 5 years. Does debt and supply matter in the UK this morning? Apparently it does.
We saw yields go up, we saw a real response, but it wasn't a Liz Truss moment. And I guess that's sort of the goal of the whole affair. Deutsche Bank put this really well, saying this marks one of the largest fiscal loosening of any UK fiscal event in decades. And it raises this question that you raised yesterday, John, which is essentially you had this divergence between the U.S. and UK. And is the UK going to move a little bit more to the U.S. than the U.S. in terms of fiscal restraint moving toward Europe?
There's a word I would use, and it's yet, not yet. Not yet a Liz Truss moment. Let's see how this market deals with this. Let's see if it deals with this in a sensible fashion. Bear in mind that the Liz Truss moment, there were other things going on in financial markets at the time that contributed to that move. I'd pinpoint this one, November 7th. We've got a Federal Reserve decision, also got a B of E decision as well. How is the Bank of England going to think about these numbers? Because the move at the front end really is a market that's assuming this Bank of England is going to back away from rate cuts. And we'll find out next week if that is truly the case.
And that was part of what was underpinning some of the moves earlier when you did have a bit of an overreaction. You also have to see what the growth projections are. And as people look through the line items to understand how much growth really does offset some of the increases in spending.
Sterling, 129.95. Under surveillance this morning, Meta and Microsoft delivering some disappointing results. Meta warning of more losses as it continues to ramp up spending on AI. Microsoft forecasting just slower cloud revenue growth, just a little bit softer. The stock is down by close to 4%. 4% on both Microsoft and Meta. Though on the year so far, these stocks have been absolutely flying.
Yeah, I looked year to date. Meta is up 70%. I mean, Meta has just been absolutely flying. Microsoft has seen its lead chipped away, and suddenly year to date, it's up some 15%, still doing really well. But you just see this feeling, are we really kind of reaching a tipping point where companies are reassessing how much they need to invest in this? I also wonder how much Microsoft is sort of hamstrung between the expense of NVIDIA chips and the ability to really innovate and roll it out and compete at a time where you see companies saying, okay, hold on, let's see how good some of these apps really are.
Being constrained by capacity is not necessarily a bad thing. Some people might consider it to be a good thing. It becomes a bad thing when investors are losing patience over how much you're spending on CapEx already. And I wonder if that's the moment we're in, just how much patience is left going into 2025.
Yeah, especially at a time where the data and the technology is changing so quickly that people might say, well, if I wait another extra couple months, then maybe I could get something even better. Honestly, what you did see was also a very high bar set by Google. And frankly, Microsoft just failed to meet that very high bar, and it was penalized pretty significantly.
When it comes to AI, it's not even just the expense on chips, and maybe NVIDIA is holding them back, or the expense on the actual products. It's also the expense on the actual energy to run all of this, which we've seen a number of these companies go out and ink their own energy deals. This line stood out for me from Microsoft CEO Satya Nadella. Company's AI business is on pace to clear a $10 billion annual run rate of revenue next quarter. That's pretty incredible.
Amazing. That stock is down just slightly. We'll pick up on that story in just a moment. The latest out of Japan, the Bank of Japan keeping interest rates unchanged, but allowing for the possibility of another rate hike in the coming months. The yen gaining strength after Governor Ueda said currency markets have had a major impact on the economy. Dollar yen's down about 0.7% at 152. It was heading towards the worst month going back to November 2016. Just erasing some of those losses, but still on the month, we've had a 6% move on dollar yen this month. And for anyone familiar with foreign exchange markets, 6% moves on major currency pairs are monster moves.
The yen has been in a world of its own for the past couple of months. And now the question is, how much is the Bank of Japan realizing they need to explicitly say they are targeting the yen to try to prevent it from weakening too much? Economists surveyed by Bloomberg expect that if the yen hits 155 against the dollar, the Prime Minister will probably say, you know what, go ahead, hike those rates.
Just a little bit of yen strength off the back of that story this morning. Let's stay in Asia and move to China. China's economy showing signs of stabilizing following stimulus measures. The National Bureau of Statistics saying factory activity unexpectedly expanded in October after 5 months of contraction. PMI data also coming in higher than expected. So things just improving slightly, but still waiting for the boom. I think in the West, we're still waiting for the boom that doesn't seem to be evolving over in China just yet.
Two things. The fact that they came out with stimulus before the election makes me realize maybe things were even worse than some people had been expecting. And you're seeing that just on a peripheral level with some of the earnings that have been coming out. And number two, just the fact that they're holding their MPC meeting from November 4th to November 8th to figure out how big the bazooka is going to be after, guess what, the election's already supposedly rolled out, and maybe we'll know who won. So it raises the question, how much more will they have to go and stimulate if one person gets elected over another who might go harder on tariffs?
That's the latest out of China, looking ahead to 2025 and what might be in store for those policymakers. If you are just joining us, welcome to the program. Equity futures on the S&P down by about 0.8%. Disappointment over at Meta and Microsoft weighing on stocks this morning. Looking ahead to Apple and Amazon, both on deck, as those companies report after the closing bell a little bit later on today. Stefan Stawinski of BNP Paribas with tempered expectations for Amazon, writing, after being a market favorite in 23 and early 24, sentiment has cooled a bit with concerns over margin progress. We see the outlook as balanced. We're neutral rated. Stefan joins us now for more. Stefan, welcome to the program. Let's get to later on this afternoon after the close. What's the first thing you'll look for?
Yeah, so today on Amazon post-close, I think 3 things people are going to be looking at. Of course, Amazon Web Services growth, no surprise there. 21% is the buy-side expectation, we believe. With those good Google Cloud results and actually Azure results being pretty good, maybe investors will be looking for even more upside there. Is Amazon finally catching up in AI relative to Google with the Gemini model and, of course, Microsoft with that GPT model access? Second thing, as we point out, is those North American margins. That was such a big driver of the story last year, improvement in profitability. It's kind of stalled this year. You've had things like Project Kuiper, satellite launches pop up and hold back margins a bit. So consensus is expecting a big step up in Q4. Will we get that? And the third thing is just overall top line. What is the consumer like? We saw eBay disappoint last night. There's been mention of maybe consumers holding back because of the election. Last quarter, third-party sellers at Amazon seem to be holding back. So we could see revenue growth guidance fall into the single digits. And with a stock on 30 times plus earnings, is high single-digit growth enough?
Stefan, the politics, I think, tees up a fourth thing to look at, and maybe it's a 4Q story. Do you think there could be a Bezos boycott emerging for some Democratic voters?
I don't know about that, but we are starting to field questions around Amazon and potential impact on from tariffs. So, what would that mean for the price of their goods? And also, what would it mean for the pocketbooks of those shoppers shopping on Amazon? So, as we head into next week, amongst the larger cap tech, the larger cap software coverage, that's probably the one that people are starting to get a little bit concerned about from a tariff standpoint.
So tariffs more important than, say, regulatory action, Stefan, is that correct? And I ask this because we've heard a lot in a number of different reports about what the specter of potential breakups or restrictions could be with respect to either candidate, depending on who they put in their cabinet positions.
Yeah, I think in this space, obviously Google's the one that's under the most imminent regulatory threat. So that's an overhang that we've seen on Google stock this year. I think when you look broadly, there are always questions around Amazon, Meta, Microsoft, in the U.S. and internationally about regulation. But we'll see if that changes under new administration. M&A is also a big topic. I think these companies have all been a bit gun shy after Amazon got blocked for buying iRobot. And so maybe they're holding back on that, and we'll see if they open up the M&A guns post-election.
So that's Amazon. With respect to Apple, there's some really interesting questions about how high the bar is for them to show outperformance at a time where there still is lingering skepticism about their ability to really implement AI with any kind of speed and efficiency and, frankly, use cases that will encourage some sort of upgrade cycle. Stefan, how high is the bar at a time where Apple is maybe the most exposed to a number of different issues that are out there?
Yeah, I think Gen AI data is important for all of these companies. What kind of usage are we seeing? Obviously, Apple Intelligence launched just this week, so probably a bit early to get that data. Last night, we heard Meta talk about 500 million monthly active users already for Meta AI. Of course, Google talking about rolling out their AI capabilities across 15 different apps with 500 million users. So, certainly that's something that's in focus. Obviously, AI monetization. I think Microsoft was reminding you last night, we are the monetization kings when it comes to AI and software with that $10 billion ARR that they expect this upcoming quarter. And then, of course, cost. Apple's not the one that's spending the most on CapEx. Will that change? Will they invest more in their large language models? For now, it's really still Meta, Google, Microsoft that are leading on that CapEx front. And that's where people are getting a little bit nervous. When are we going to see light at the end of the tunnel in terms of CapEx growth slowing and revenue growth potentially accelerating?
Stefan, we're a week away from the U.S. election. John was leaning towards this when he talked about this boycott potentially of Prime, because we have seen a boycott in Jeff Bezos' Washington Post, people canceling their subscriptions. But the course of the past 2 weeks, we've learned about Tim Cook having a check-in call with the former President Donald Trump, Amazon CEO doing the same, the Google CEO calling him up. Are you seeing a tactical shift in the tech space and these CEOs hedging their bets for a Trump administration?
I mean, I think when you highlight the data points, about those CEOs obviously remaining neutral and, courting both sides of the campaign, that's something that they're continuing to do. So, like I said, we don't know what the outcome will be, of course, and, these companies are hedging their bets. Regulation is an area of focus. M&A is an area of focus. And so, all these companies essentially are trying to, stay neutral as we head into next week.
Good luck to them. Stefan, good to catch up, sir. Thank you. Stefan Stawinski there of BNP Paribas Axan. I think we all saw the reports in the last few days that the Post has lost, 250,000 subscribers?
At least, almost immediately, 250,000 subscribers. And to your point, The Atlantic came out in an opinion piece and said, don't cancel the Washington Post, cancel Amazon Prime. This is going to be a potential problem for a lot of CEOs. They want to stay out of the spotlight of politics because they don't want the blowback on their companies.
We'll see if this comes up a little bit later. NASDAQ futures right now down by 1 full percentage point. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Stellantis reported third quarter revenue that slumped 27%. It shipped fewer cars from factories in most of its major markets. Here, as you can see, there are still higher pre-market, nearly 3%. Analysts say that European revenue helped offset North American weakness. Stellantis has seen, though, delays in new models, product recalls, and shrinking market share in both the U.S. and Europe. Starbucks reported its third consecutive decline in same-store sales. Shares little change this morning, up just 0.5%. The new CEO, Brian Nichols, said that he's focused on the future, aiming to reduce drink customization, trim the food and beverage menu, and bring back touches like ceramic mugs and a condiment bar to make sure that the Starbucks experience feels less like fast food. Nichols also said that a goal of getting drinks in-store to customers in less than 4 minutes. President Joe Biden and First Lady Jill Biden hosted their final White House Halloween event on Wednesday. Yes, that is for the First Lady dressed up as a giant panda to greet trick-or-treaters. Her costume was a reference to her participation in the Washington National Zoo's announcement earlier this year that pandas would be returning to the nation's capital. The animals arrived 2 weeks ago. The White House said her costume was a, quote, welcoming gesture. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the economy, front and center on the campaign trail.
I will give a middle-class tax cut to 100 million Americans.
You know, I had no inflation, and we had the best economy in history.
That conversation up next, live from New York. You're watching Bloomberg TV.
In case you missed it on Bloomberg Technology.
We're excited to really change the expectations for space companies where you have this always-on, reliable, and frankly dynamic satellite connectivity that you would expect of your power grid or of your cell phones. And so we think that this is a huge opportunity space, and our first contribution to it is through shared infrastructure.
You can see this whole ecosystem developing, and you have an exponential growth right now because easier access to space means more demand for space, and that's the definition of an exponential growth function. So if you think about someone like Varda, who is only possible now because access to space is cheaper and easier, we're demanding more access to space.
I think that's what's so exciting from a business perspective, the fact that if you can do it, you know, you're one of the few numbers of organizations in the history who've actually pulled it off. And so it creates a very defensible position, because again, space is very, very hard.
Don't miss Bloomberg Technology live every weekday.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live every trading day. Balance of Power live around the world every weekday, only on Bloomberg.
tough morning so far, down 0.8% on the S&P 500. Losses on Meta, on Microsoft, going into numbers from Amazon and Apple after the closing bell. In the bond market, yields a little bit lower. We're down 2 basis points. The 10-year 427.63. Under surveillance this morning, the economy front and center on the campaign trail.
I will give a middle-class tax cut to 100 million Americans. Enact the first ever federal ban on price gouging on groceries, and fight to make sure that hardworking Americans can actually afford a place to live.
You know, I had no inflation and we had the best economy in history. That's a nice combination. But she did nothing about it.
So here's the latest. Harris and Trump honing in on the top voter issue, the American economy, as polls still show a finely balanced race with less than a week until Election Day. Kurt Ryman of UBS saying the next U.S. president should inherit an economy with firming activity and declining inflation. Although price levels remain uncomfortably high for many Americans, higher tariffs and the expiration of tax cuts are key risks to the outlook. Kurt joins us now for more. Kurt, welcome to the program.
Thank you very much.
Before we get to the outlook, let's deal with the here and now. Just this difference between the way we talk about the economy around this table, from a financial market perspective, GDP's great, unemployment's low, this economy is still resilient, it's doing well. The word solid comes up repeatedly in research. How big a difference is there between that conversation and what you see in polls?
It's the number one issue that Americans say that they think about when they go to the polls. It's extremely important. And there is a disconnect between what we talk about, where we say the economy is decent, and what we're talking about is that a year ago, the worry was a recession. So today it's not a recession. If you look at some indicators like inflation that came down, people are feeling less miserable. They're not feeling better or euphoric. This is an economy where people are going to re-up their car insurance or their home insurance, and they're reminded of the high inflation rates over and over and over again. So this is not an issue that's going away for them. If you're looking at what the Fed is thinking, they're saying, yeah, the economy is balanced, inflation's come back to target, growth is looking better than we thought it would look 6 months ago. The consumer is in decent shape, but if you ask Americans how they're feeling, it's a very different reaction.
When you look at the swing states, is there one state that stands out where inflation maybe is hurting Americans more?
Not particularly, no. I wouldn't say that you could pick that out from the states, but what you do find is that there's a very big difference between what voters in the swing states feel are important issues coming into the election. A Gallup poll from September ranked what Republicans thought were the 5 most extremely important issues going into the election, what Democrats thought were the 5 most important issues. There was no overlap whatsoever. Republicans, by a much larger majority, find that the economy is the top issue. Democrats, it's not even in their top 5.
When it comes to the economy, though, and you look at what economists say a Trump administration could bring, it could bring higher inflation, which is exactly what they say they are going in to solve. Is that landing?
Not to my, I mean, what I would say is that when you think about the outcome of the election and what is likely to turn into policy, we first have the presidential election, which is a toss-up. But then when you go to what's going to be enacted, what is going to happen with legislation, whatever majorities we have in Congress are going to be razor thin. So when you think about deficits, that's a constraint. But then there's also what's happening in the bond market. Rates have been rising. Deficits as a share of GDP are double what they were in 2016. So the idea that either candidate is going to get everything on their wish list, I think, is a limiting factor with respect to how this could pan out for inflation and for the economy.
Is there a sense of sell the rumor by the news when it comes to the bond market that because of what you said, it's going to be difficult to enact anything single-handedly, that yields are going to come back down and realize that any extra premium that they put in, regardless of who wins, is going to come out?
Yeah, there's in the last several weeks, there's been a certain fear factor in the bond market with rates rising. We thought that when rates had gotten down on the 10-year to around the 365 level, that it was fully valued. And so we were advising our clients to not get too far over their ski tips in the bond market. We thought rather that we would want to extend some duration, but really out into the belly of the curve, not further out the curve. We've had that backup in interest rates, and I would say continue to leg in here at these levels, but not to the point where you're overextending on duration. Because the thing is, with the election result, if you get a Trump victory, I think the odds of a bear steepener, yields rising on the back end more than on the front end, I think that's pretty likely. But under a Harris administration, it's more likely to be a bull steepening. Either way, you're not doing as well out the long end. But the key here is that in bonds today, you're getting 4.25%, 4.5%. If you're looking to investment grade bonds, you're in 5% land. That's a gift compared to the last election or the election before that.
A lot of people who come on the show agree with that and seem to have the same kind of idea about a bear steepener or a bull steepener, but a steepener nonetheless. Where there's less conviction is about the relationship with the dollar, overlaid on top of all of this.
Yeah.
Will higher yields and some of the agenda items that we've heard from a Trump administration in particular lead to truly a stronger dollar?
I think what we need to consider here is the short term versus the longer term trajectory. We've seen today some news out of the Bank of Japan talking about over the longer term lifting rates. China is working to resuscitate their economy. The U.S. is in a position where over the next year we should be expecting rates to come down. That's what the Fed is telling us. There's been some question as to how much that comes down, but next year rates should be lower. That, I think, altogether augurs for a dollar weakening, and it is at the sort of upper end of its historical range. So I think it's expensive and should cheapen, but on a Trump victory, I think initially, if there's some safe haven flows, that would benefit the dollar, but only on a short-term basis.
Kurt, we've got a lot of work to get through next week, that's for sure. It's good to see you, sir. Kurt Ryman there of UBS. Just starting that conversation on the difference between what we see in the data around a table like this and what you see in the politics. Markets have to speak to the aggregate. The politics are speaking to the disparities, the bifurcation amongst the consumer. We saw that from Bloomberg Economics yesterday. They broke down consumer spending. The main growth driver that we saw pop up in a GDP report yesterday has been narrowly boosted by upper-income households with lower-income ones who have grown more price-sensitive. And that's where that anxiety comes from. We're talking about prices going up less fast. That's what we do around this table when it comes to the bond market and Federal Reserve policy. Everyday people living in this economy at the moment are still thinking about a price level that is materially higher than it was 5 years ago.
And they're reminded of it, as Kurt said, when they go to potentially pay their auto loan, or they go to pay their rent, or they go to the grocery store. And that's the issue. Those prices are not coming down, even though the rate of how much they're going up is.
Which is why that conversation is still very, very different on the campaign trail versus, say, Wall Street. Equity futures right now on the S&P 500, just a little bit softer. We're down by 0.75%. Weighing on this market this morning, earnings from big tech. We've heard from Microsoft and Meta. A little bit later on, you'll hear from Amazon and Apple. Looking ahead to all of that, we'll catch up with Daryl Cronk of Wells Fargo, Evan Ross-Smith of Slingshot Strategies, Pierre Ferragu of New Street Research with a few things to say about Apple, and we'll catch up with the latest coming out of Blackstone with a big push to build out data centers for mega cap tech. How those two worlds collide in just a moment. From New York, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on...
It's not that great a business as a business, casualty insurance. It's a tough game. There are temptations to be stupid in it. It's like banking. Once I asked the man who just left a large investment bank, and I said, how does your firm make its money? He said, off the top, off the bottom, off both sides, and in the middle. The general system for money management requires people to pretend that they can do something that they can't do, and to pretend to like it when they really don't. And I think that's a terrible way to spend your life, but it's very well paid.
I'll raise. I fold. Where's Warren? Well, unfortunately, I wasn't Warren's type. Oh. Well, who needs a billionaire anyway, right? Oh, I got myself a billionaire. It's just not Warren. Come in, sweetie.
Hi, girl. really Jamie Lee Curtis?
Is this really Mr. Hunger? I mean, Munger, excuse me. Please call me Jamie as long as I can call you Charlie.
Hi, Charlie. I'm Susan Lucci. Oh, haven't you heard about the deal between Warren and me? He's going to be a big star and all my children, and I'm going to be taking over Berkshire Hathaway.
Well, you certainly got some important qualities that Warren lacks.
Well, thank you, Charlie. There's some changes I really think we need to make around here. The first thing we need to look at is our dividend policy. I have never heard of anything so cheap and so unfair to our wonderful shareholders. We need to change it.
Sounds good to me.
Charlie, have you seen the new trailer for Iron Man 3? It's really amazing.
Iron who?
Charlie will get on his knees for you. I can
check, please.
Yeah. Do we have a deal?
Okay, yes.
Oh, thank you. Charlie, it's about time. I'm right up.
Who's that, Charlie? Oh, give me the phone. Give me the phone. Give me the phone. Charlie, it's Jamie. Oh, it's so good talking to you, too.
1, 2, 3. Hi,
Warren Buffett.
All right. I'm going to call my partner and have him draw up the papers.
Wait a minute. Did you just put that piece of brittle back in the batch? I'll try that. Contaminated the whole thing.
Charlie? It's done.
Slick, yo. Brittle, bitches.
Bond market, the scores on the month, what a move we've seen. 50 basis points higher, there and thereabouts at the front end and the long end on a 2-year and on 10s. Yields down this morning by 2 or 3 basis points, 427 on 10s, 416.82 on 2s, and later this morning, 90 minutes away, Lisa, jobless claims.
Yeah, at a time where there's really a sense that every economic data point has been surprising to the upside, which has really fueled this move. There is a real question that has started to percolate among investors, which is how high is the bar for the Fed to not cut next week, especially given such a fraught circumstance that they're going to be meeting in.
When you look at the ADP and then potentially the jobless claims, and then depending on what happens in this payrolls report, if it's not on the lower end with Bloomberg Economics, -10, it's on the higher end, you get the surprise, and we have a U.S. presidential election and potentially no result when the Fed meets. I think the bar is relatively very high, considering the fact they already cut 50.
The median estimate in our survey just coming down just a touch, if you want a sneak peek. 110 yesterday, that median estimate's down to 101. The high's still the same, 180. The low's still the same, -10. But the median's dropping back to 101 going into tomorrow.
Yeah, although some people saying that the reason why job openings, and the reason why I flipped to job openings is because this is partly because you could read the job openings any way you want. You could probably interpret in that the labor market is getting a little bit more calcified. But one of the reasons why the job openings have come in is because people were hired in such big numbers last month. So taking out the mess, taking out the hurricane disruptions and the strikes, there's a question of whether we're just reaching this point of stasis, of not much movement, and it could go one way or another.
Hoping we clear some real event risk over the next week. Equity futures on the S&P down by 0.7%. Coming up this hour, we'll catch up with Darryl Cronk of Wells Fargo on disappointments in big tech. We'll speak to Evan Roth-Smith of Slingshot Strategies as Trump and Harris hold dueling rallies in Wisconsin, and Pierre Ferragu of New Street ahead of Apple earnings later on this afternoon. We begin this hour with Meta and Microsoft weighing on stocks. Amazon and Apple set to report after the close this afternoon as equities remain on track for a 6th consecutive monthly gain. Darryl Cronk of Wells Fargo writing, strength looks durable and sustainable. The key will be to maintain some semblance of stability in the 3 E's, earnings, elections, and employment. Darryl joins us now. Are you seeing that stability, Darryl? Good morning.
We are so far. I mean, to the conversation that just happened, right? You can draw your employment piece any way you want to, right? I mean, to the point of jobless claims, better, ADP better, but if I also took JOLTS earlier this week, terrible. If I took Beige Book, bad, right? So there's a dichotomy there which we face, and we've been facing for quite some time. I mean, on the earnings front, we think the quarter ends somewhere around, when the dust settles, around 5 to 6% earnings growth, which is above the 3% we walked into, but certainly probably underwhelming. You get 49 companies today, which is 10% of the S&P market cap, 10% of the companies and 17% of the market cap alone today, right? So it's going to be a busy day, not just within tech, which we're highlighting the Mag 7 and all that, but beyond that, we get to see a lot of good data today.
Well, two names are responsible for the bulk of that percentage. We're going to hear from the likes of Amazon and Apple.
Right.
How high is the bar for big tech based on these price moves this morning off the back of the earnings from yesterday?
I think it's pretty high. I mean, the reality is, if you backed out and looked at big tech, this will be the weakest quarter of earnings growth in the last 6 quarters, right? Now, again, still robust, but you can look at the dichotomy. I mean, simply look at what's happening even within tech. Google strong on cloud services, AMD weak on chips, right? So you get this really, intense bifurcation that's starting to separate those. And what's really, if you even broaden it out beyond tech, what's happening in the stock market as a whole is the double beats, right? If you beat on sales and beat on earnings, your stock price is killing it, right? You're seeing 5, 8, 10% moves, right, in a single day. Obviously a double miss, right? Same, symmetry to the downside. So the moves, right, as we separate kind of the haves and the have-nots, or the bifurcation, to use that as the word of the day, seems to continue not just in the delivered sales and earnings, but in the price action.
This is something that Julian Emanuel pointed out, too, that just the magnitude of the single stock moves on beats or misses really has been notable. I wonder what your takeaway is from that. Is that healthy? Does that indicate stock picking, or does that indicate that people really just have no idea and they look and expectations are where they are and people are kind of willing to sell or buy on a trigger finger?
I think it's an indication, a little bit of extended positioning, right? So positioning has been obviously robust, strong. Everybody's out a little bit on the bullish side over their skis, so you've had to calibrate that, back. And I also think it's as it always is in earnings season, it's incumbent on the outlook, right? So if you're not providing good transparency and a good outlook number, your stock price is getting hurt badly, right?
When it comes to sort of these specific stories, I wonder how long it takes until we get some sort of macro overlay. And I think of big tech as being the macro overlay that led to so many of the gains that we have gotten so far in the stock market. Can the stock market continue to gain if it loses that pillar for a fundamental reason?
Yes, it can, because we've seen the breadth widen, right? So financials on an absolute and relative basis are doing extraordinarily well, obviously on the back of the steepening yield curve and what's happening with interest rates. Industrials are probably the best performer on the board, right, on a relative basis. So tech has actually stepped back. If you look at the 11 GIC sectors on a relative basis, tech probably falls in the 7, 8 category today as far as leadership goes. And so it already has stepped back. Now, what it can't do is decelerate materially, right? And I think where people are holding tech, to John's point earlier, feet to the fire, is they want to see where that next incremental growth is going to come from. Like, we've priced in brought forward a lot of the AI, we've priced in a lot of the CapEx spend that's going to happen in 2025, because we know that number this year was 40 to 60% across the board on CapEx spend in the tech world. Next year, it's probably 30 to 50. It's down, but it's still robust. But if you don't monetize that, right, into incremental revenue, then I think tech does struggle to lead. And you've seen that in the multiples. So the multiples have come from 31 times in the summer on the sector back down to 28. You've had a 3-point contraction, in the last probably 90 to 120 days.
So we hit 2 out of the 3 E's: earnings, employment, the election. You think we have any semblance of stability when it comes to the U.S. election?
Probably not, to be honest, Anne-Marie. I mean, I do think what you're seeing is obviously, and it's been well documented, you guys have talked about it many times, the Trump trade, right? Smalls outperform, rates up, inflation expectations up, gold outperforming, dollar outperforming, emerging markets weak, right? China, Mexico, all that stuff. I think if you end up with a red wave, right, I think U.S. exceptionalism continues, right? the globe struggles, right? Global trade policy, which you cover well, becomes very transactional, right? It's Taiwan, you need to pay for your defense. Europe, you need to chip in your fair share. We need to go resolve, conflict by conflict. Russia, Ukraine is how the administration, I think, will try to tackle global trade and policy outside of the tariff issue, which again is
But you don't think exceptionalism continues with a Harris administration?
Not as much, right? I
Even
think
though the rest of the world is weaker?
I think the rest of the world's weaker on a relative basis, but not to the extent you would see out of that red wave, right? I think you'd really push it to the tails, right? So in other words, if there's a red sweep on Tuesday, I think you have to think about China's woes, Europe woes getting worse, right? Because you're going to limit their ability to export goods, right, through the tariff mechanism. You have to think about the nearshoring of Canada and Mexico that's been happening the last few years. As we think about, gee, we need to renegotiate all of the North America trade agreements, which will be on the table with a red wave. So I do think the globe gets weaker on a relative basis under a red wave. It stays weak under Harris, but not as weak.
But exceptionalism within the U.S.,
Yes.
is that going to be very hard if there are tariffs and inflation does go up and there is a constraint on immigration and it starts hitting the labor market?
Yes. I mean, look, I mean, you guys know well, tariffs at their core are friction into the global trade system, right? But I also think people fear it worse than it is. If you actually just run the numbers, right, and you say, okay, let's take China, right? Today, the average tariff on China is 19%. We import about $430 billion from China. So if I take it from 19 or call it 20 to 60, it ends up being about 8/10, 9/10 onto inflation. So it's inflationary, but it doesn't tip the boat over type of thing. Same thing on global trade. If I take 10% on global trade of 2.7 trillion, right, there's real numbers there. So you can back into the math to understand what the economic impact's going to be. And I don't think it's quite as bad as people have extrapolated.
Darryl, let's wrap it up. Stocks and bonds. Middle of this year, you preferred large over small, DM over EM. You weren't chasing small caps. Your 10-year call, 450, looking pretty good from the middle of this year. What's the stock and bond view now?
So I would say semi-stable on stocks. So if you roll out to year-end 2025, we're about 6,300 on the S&P. So decent return. The pound-the-table trade we've been trying to get our people to pay attention to is now's the time to take the bite at duration, right? Somewhere in the 430, 450. A lot of people were gnashing their teeth because they missed it in the summer months when the 10-year was down at 360, right? And they thought, the Fed's going to keep cutting rates and, the curve's going to just shift all the way down, and I missed my opportunity, and reinvestment risk is real, right? Because we haven't had to deal with it since 2006, basically, in a 15-year zero interest rate environment. So we're trying to tell people, look, don't be asleep at the switch, right? Don't crowd all your money to the short side of the curve. Start biting on intermediate and long duration. Maybe we go to 450, maybe 475, but not much higher than that.
You know how this works. It's the only sale an American consumer runs away from, a financial market sale.
That's right.
Bonds on sale.
That's right.
Yield was 430. Your 10 years down 2 basis points. Darryl, it's good to see you.
You too.
Appreciate it.
Thanks,
Thank you, sir. Darryl Cronk there of Wells Fargo. Looking ahead to next week. Just a monster week just around the corner in this country. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Some more earnings to get through. Uber shares falling nearly 6% pre-market. It did deliver a record operating profit, but it had weaker than expected ride bookings. Uber also issued a more muted forecast for the holiday quarter. The rideshare app said it struggled with FX headwinds, which weighed on its rideshare business. Uber has also been investing in new offerings in recent years, seeking to transform itself into a consumer super app. Peloton shares, on the other hand, jumping pre-market 5.3%. The company named Ford executive Peter Stern as its next CEO effective January 1st. Stern will be charged with turning around the long-struggling fitness company. Peloton reported second quarter results as well this morning, including revenue that missed estimates. The Grammys are relocating. The Walt Disney Company won a 10-year deal to broadcast the awards starting in 2027. That deal ends CBS's more than 5 decades as home to the show. According to the statement, the Grammys will air on ABC and Disney's streaming platforms, including Hulu and Disney+. As part of the agreement, Recording Academy will produce multiple Grammy-branded music specials and other programming across Disney platforms. And that's your brief, John.
Got things to say about Hulu pricing. Save those things for another time, after the election. Up next on the program, dueling messages to swing state voters.
allowing Russia to go into Ukraine October 7th and Israel. All of these things would have never happened if you had a different president.
Donald Trump trying to keep us divided and afraid of each other. That is not who we are.
A conversation up next, live from New York this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is The Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Equity futures on the S&P 500 just a little bit softer. We're down by 0.7%. Yields coming in 2 or 3 basis points. Just trimming that monthly advance, 427.43. Under surveillance this morning, dueling messages to swing state voters.
Inflation that should have never happened, allowing Russia to go into Ukraine October 7th and Israel. All of these things would have never happened if you had a different president.
We have an opportunity in this election to turn the page on a decade of Donald Trump trying to keep us divided and afraid of each other. That is who he is, but Madison, that is not who we are.
So here's the latest. The Trump and Harris campaigns making the final push in a series of swing state rallies with early voting well underway. Evan Ross-Smith of Slingshot Strategies eyeing opportunity for Harris in the final days of the race, writing the decisive voters in the final stretch of this election are left-leaning people in right-leaning environments. Evan joins us now for more. Evan, good morning. So we're chasing a few 100,000 voters, as you suggest, across just a handful of swing states. Just elaborate on what you said there. Chasing left-leaning people in right-leaning environments. What do those people want to hear?
So we dialed in our last round of polling on the only people who really are casting decisive votes, right? People who are undecided or who could conceivably change their vote between now and the election. And what we found is that a lot of them are, as we say, they're people who are sort of inclined towards, they usually split their tickets, but they're a little more Democrat than Republican, but they are surrounded in their lives by Trump supporters. They say most of the people in their lives are Trump people. So these are, the one Democrat at the Thanksgiving table kind of situations. And are they going to break from their family or, the people around them? Are they going to vote against sort of their environment? And we haven't released this yet. This is coming out today. But we found a lot of them are Obama-Trump voters. So that's who's really left on the table, and they're cross-pressured on all sorts of policy preferences. They're anti-immigration, but they're pro-choice. They don't like corporate greed, but they also don't like government spending. So they have a lot of pressures working on them, and 60% of them, when we ask them, what the heck are you waiting for? What do you need to hear to make a decision? A lot of them just say, I just like to wait. I just like to wait until the last few days, and that's what they're doing. They're waiting.
Who do you think they're going to break for?
I think Harris has. It depends on how they close, how these two candidates close. The in-person rallies, where they go in the last few days, actually has a lot less to do with it. These voters are more internally focused in terms of their decision than is Donald Trump in the zip code next to me or Kamala Harris in the zip code next to me. Harris, if she closes on the economic message, I think has a way in. If she closes on something a little more nebulous, these are not voters who vote on democracy necessarily or January 6th or anything like that. If she closes on something more nebulous and Donald Trump closes strong on immigration or safety or some of these other, crime, these kinds of concerns that these voters are very sensitive to and more aligned with Republicans on, he'll do well.
Let's talk about where the candidates are going, though. Donald Trump is going to New Mexico. We've never seen New Mexico vote for Republicans since Bush years, 2004. And then he's going to Virginia this weekend. Do Republicans think they can actually play in these states?
I have no idea, but I'm very glad that they are making these choices as a Democrat. It doesn't make a lot of sense to put them there. I get, if it were for a rally or a show or some, or for, a podcast, something with mass impact, I'm not quite sure why he's in these places. Harris is basically living in the swing states, but whether it really makes a difference, as I said, it comes down to just a handful of votes.
Okay, so the closing argument you say it comes down to, how much did Biden undermine her this week?
It didn't help.
And then Trump went off and made a meme about it.
Yeah, and Trump's doing this garbage thing. Again, but the only people who are really strongly reacting, Joe Biden is reviled. These swing voters, again, this data is coming out today, so.
Sneak peek.
Yeah, sneak peek. But these swing state swing voters, Joe Biden is minus 45 favorability with swing state swing voters. So it's not like they were waiting on the final word from the president to decide how they were going to vote. And Donald Trump doing the Donald Trump show isn't going to persuade them either. Now, if I'm Donald Trump, I am probably still more concerned about the Puerto Rico impact of my comments. In a state like Pennsylvania, there are 500,000 Puerto Ricans. Joe Biden won Pennsylvania by 80,000 votes. Don't love those numbers, right, if I'm Donald Trump.
I want to just dig into that comment that Joe Biden is reviled. How well or not well has Kamala Harris really distinguished herself from him? And at this point, her response to that whole situation was, look, he walked him back, but that's not how I feel. Is that enough?
I wish she had hit it harder. I don't think there's much left between now and Tuesday where she can redefine her relationship to the president. All of our research showed strong distance would have been better. They never really got there. This week about when she was responding to what he said about garbage or whatever he was trying to say about garbage, she sort of drew the distance, but that's kind of where she's always been. She's sort of drawn the distance. Wish she had done a little more of it. Maybe would have helped her. Again, when we look at these voters, it's the people who are going to decide this election as of today have not made up their mind yet. They will make it up over the weekend, or they will make it up in the voting booth, or they will see one ad on Monday morning and go, that's my guy, or that's my gal, right? It's just how it's going to break.
So last night I was in an Uber going home, and the guy was listening to Hot 97, and the radio host was saying that he's going to stay home because he's just not feeling it. How much is that something that you're hearing quite a bit?
I hate to get turnout projections and playing the early vote game or the cab driver anecdote game.
Yes,
right. What else is there to do at this point? But get on a bus and go knock some doors, right? It's hard to know. I think there are pockets. I know that's a terrible answer, but there are pockets of voters that will be extremely activated, right? There are voters who are going to be less activated. And by the way, Donald Trump's strategy, basically, they've done some work to try and expand their coalition a little bit. But basically, he gets 47%. There's 53% of the country that's not going to vote for him. You just have to make sure that 53% doesn't all coalesce around one person. And if some of them stay home, great. That's a win also, right? So that's still where they are. Having a lower turnout election, there's now some contravailing evidence around what lower turnout voters might do in this election. I still think Donald Trump benefits from a low turnout election.
Interesting.
Yeah.
One candidate's got to lose, to state the obvious. But what's interesting about this is that candidate's probably not going to run again. Donald Trump's going to be too old. It's going to be unlikely they give Kamala Harris another shot, given the fact that she was gifted this opportunity and failed in a primary last time around. I think the really interesting conversation next week is going to be how these individual parties pick up the pieces and think about the future. What you said in this conversation that stood out to me is that swing state voter that doesn't fit into that neat ideology, that they are pro-choice but anti-immigration. How does the Republican Party or Democratic Party pick up the pieces and explain to the population what they're going to be in the future? Perhaps that is a difficult one, much more so, I think, for Republicans post-Trump than it might be for Democrats. But how are you thinking about that beyond next week?
Well, if Trump loses and accepts a loss or eventually accepts a loss, I mean, what will happen inside the Republican Party is going to be a bloodbath. I mean, you will have traditional conservatives trying to assert themselves. You'll have people like J.D. Vance, who are now paragons of the Trump movement, try and retain control. His sons will probably try and retain control as relatives who are running the party. That's really messy. If the Democrats lose, I mean, our question, it will also be very messy. No question about it. But the Democrats did a pretty decent job of sort of trying to move the party a little bit towards the center over the last year. We wound up with a messenger. Kamala Harris is sort of an uneasy messenger for, she's a California senator. She is a pretty dyed-in-the-wool liberal. She was comfortable pivoting left in a way that not every candidate. Joe Biden didn't pivot as far left as she did in the 2020 primaries. But the question is if the Democratic Party can sort of stay on target with this slightly moderated positioning on fiscal policy, on immigration, if we are a little more muscular about taking credit for our economic policy, right? I mean, the economy, low inflation, full employment, approaching 3% GDP growth. We're not allowed to say it, but the economy is incredible.
On paper, but it's not what people feel.
No, it's not what people feel, but on paper.
But isn't that the problem with voting?
Yes, that's the problem. But it's also about leadership and being able to say. I mean, if Donald Trump were president right now, he'd be like, "This is the best economy in American history," right? And he'd be pretty close to right.
Why don't they message that better?
Because Democrats are poor messengers on the economy.
This administration has been shocking at it. And we've said it repeatedly on this program, and I can compare and contrast the two administrations being here in America through both of them, that the access you used to get to the economic speakers from the Trump administration was constant. It was every single month. You barely hear from this administration. And I think that's been to their detriment. I think about some really strong payrolls reports, whereas you say if it was Donald Trump still in the White House, we would have had a Rose Garden address, balloons. On a day like today, we would have had pumpkins and a Halloween party.
Would have been a party.
Right? And we just haven't seen that from the Biden administration at all.
I wonder if they try to bury it because they know people are still so concerned with inflation and they can't say in their face, well, this data is really good because they're not feeling it.
Possibly. Evan, a lot to think about for the future as well. This was really insightful stuff. Appreciate your time. Thank you, sir.
Thank you.
Evan Ross Smith there of Slingshot Strategies. Up next on the program, we'll catch up with Pierre Federer of New Street with Apple set to report earnings after the close. From New York, this is Bloomberg.
the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Equity futures right now pulling back by 0.7%. There's a big tech effect this morning. We'll get to those single names in just a moment. On the Nasdaq 100, we're negative 0.9. 2 hours away from the opening bell. With your morning movers, let's cross over to Manus Cranny. Morning, Manus.
Jonathan, a very good morning to you. I know we can't throw everything into the monolith of everything is tech, but 24 hours after Alphabet talked to you about the efficiency of AI and what they're doing. This morning, we see Meta down 3%. This stock is up 67% into this opening trade. We have a conundrum. They're going to raise the CapEx. Okay, they've raised the lower guidance on CapEx, but they've also told you that advertising is 96% of the revenue numbers here. Revenue there is going to slip ever so slightly. So that differential is something you need to keep an eye on. Yes, AI, you're spending 8% more time on Facebook, 6% more time on Instagram, but it is about, trust me, we will show you the path forward. Roll it over and have a look at Microsoft. We have a constraint in our issue here. This is capacity constraint in AI. The current quarter, you're going to see cloud usage slip, or the cloud revenue drop to 33 to 33%. That's down from 34% in the first quarter. So we have a capacity constraint. What do? Throw more money at it? Build more data centers? That's the issue for the market in terms of solving that capacity constraint. Satya Nadella says this business is going to be the fastest growing business in our history. The pace and the size of that. I leave you with MicroStrategy, a software company with a Bitcoin twist. The stock is up 1 1/8 this morning. By the way, 291% so far this year. This stock actually outperforms NVIDIA. Why? Because they have a lumpy position in Bitcoin, 18 billion. But they're going for a capital raise today. It's called an at-the-money equity raise. In other words, pretty much at the stock price at the moment. They're going to raise $42 billion. And guess what they're going to do? They're going to buy more Bitcoin. But I'll leave you with the thought. The business, the business that they do, well, no, the software business actually fell by 10%.
What a shocker, Manus. What a shocker. Appreciate your time this morning. Manus Cranny there with some movers this morning. Under surveillance, let's recap some of those names. Meta and Microsoft, both trading low in the pre-market. Meta vowing to spend big on investments and new technology. Microsoft slipping on lower forecasts for cloud revenue growth. Later on this afternoon, more Mag 7 earnings. We'll hear from Amazon and Apple. Microsoft, let's talk about CapEx. If you are just joining us and haven't been through these numbers, quarterly CapEx at Microsoft, almost $15 billion, a record of 50% from the same period a year earlier.
And that once was a great thing because a lot of the tech giants were saying that they can't invest enough in the AI behemoth that is becoming an incredibly dominant theme. And now there's a question of show me the money. The fact that the cloud forecast came lower was a big concern for a lot of people, especially given what we saw from Google, which was the opposite. Now over to Amazon. What does our AWS platform do, and how much do they see real gains in traction?
We've heard from these tech CEOs before. The biggest risk for them, given the trend that they're anticipating and the power of that trend, is underinvesting and not overinvesting. And I think we saw evidence of that yesterday, constrained by capacity over at Microsoft. And we've talked about this a few times. They're also constrained by the patience of the investor base to carry on investing at this rate. And at some point, they're going to have to show something for it and show a whole lot more for it to encourage that patience to remain, to hang around and keep investing in that equity.
You know, as I was reading through the Meta results and the Microsoft results, it strikes me that Microsoft is coming off a really high bar that Google set, and they didn't really meet that incredibly high bar, but they're still delivering. With Meta, there is a concern about doubling down on investments that are still losing money. And that, I think, is sort of a different characteristic, and it shows how specific people are getting with these stocks.
These start recovering just a little bit. We're down about 3% in early trading. An update on the politics. Donald Trump doubling down on President Biden's garbage comments. Trump staging a photo op in a garbage truck wearing a safety vest. Kamala Harris continuing to distance herself, saying she strongly disagrees with any criticism of people based on who they vote for. Quite the scene yesterday afternoon.
So I don't know if this is going to land, but I do look at Politico when they do who won the day. These days are so critical and they're so important. What we heard from Evan just a moment ago is that those undecideds are going to make their decision, maybe even when they wake up on election day, because they have different issues that they care about in both camps. So when you look at Politico who won the day, they say Trump won because he forced Harris to do cleanup. Harris had to go out and clean up Joe Biden's comments on garbage, and then he changed the subject and basically made a meme of it that was viral. So even if you didn't know, why is the former president in a safety vest? Why is he sitting in a garbage truck? You're probably forced to Google it and then realized, oh, he was poking fun and doubling down on what the White House was saying.
Harris is between a rock and a hard place. I've heard complaints about she should do more to distance herself from the president. Can you imagine if she did? If she did, she'd be accused of being untrustworthy and disloyal. And that's why it's so difficult to run as the vice president of this administration at this time.
This is the reason why she hasn't really divided herself as much from Joe Biden, and something that a lot of people are saying could hurt her chances with a lot of swing voters.
That's the latest on the politics. Here's the latest from the automakers. VW laying out a plan to avoid factory closures in Germany. The company saying measures include a 10% pay cut and revised bonus system. The next round of talks between management and labor leaders is set for November 21, ahead of possible strikes at the beginning of December. That stock just a little bit softer intraday.
And it talks to really this question of kitchen sinking it and basically talking about all the woes to then get that 10% pay cut that they're talking about and a revised bonus system. A question of, will they finally get the leverage to make the moves that they need to in order to be viable?
It's a negotiation taking place. We've seen the back and forth publicly over the past few weeks. Let's turn back to big tech. Results from Amazon and Apple coming after the closing bell. Pierre Ferragu of New Street Research maintaining a neutral rating on Apple ahead of earnings with a 225 price target. Pierre joins us now for more. Pierre, looking forward to these numbers dropping a little bit later. Just share your thoughts with us on how the new iPhone is doing, what you're seeing just in terms of sales relative to the same kind of thing from last year with a new product.
Hey, John. Yes. So we're just like in the very early innings of getting feedback from the market on how the iPhone is doing. As we were expecting so far, the feedback we get is pretty negative. We already hear about weak consumer reception and Apple poking on cutting orders with their supply chain, but it's still very early. What we expect usually is like late November and early December, that news flow to accelerate and more evidence of that coming. And of course, if Apple has to make like a significant adjustment to its supply chain, is going to become very tangible and material in the first weeks of January. But so far, what you see is that Apple has gained a lot of market share in China. It's now reversing with Chinese manufacturing coming back into the higher end of the market. What you see is like a consumer demand across the world. You just mentioned like the demand in the auto industry being very weak. So you don't have a lot of consumer spending. And last but not least, the big focus in terms of innovation of Apple this year was Apple Intelligence, introducing AI features to the phones. And what we see is that these features, even if they are like the right direction of travel, are unlikely to have a significant impact on consumer preferences in the near term.
Yeah, a lot to unpack there. Can we just pick out the geographic piece of it? You mentioned China. Is there a read across from the struggles of luxury, the likes of LVMH, to an Apple in China at the moment? Is that the wrong way of looking at things?
Yeah, that's an interesting one. When you look at it globally, it looks like consumer weakness tends to be more in the lower end of the market, and the higher end of the market being better protected. And that's what we saw in the feedback. Like the weakness of the iPhone 16 is more like in the non-Pro models. In China, you have potentially a different situation. You mentioned the data points of LVMH indeed, where maybe the higher end of the market could be slowing there, but it's still very early and would probably be more specific to China.
How much are you seeing the bar as being lower for, say, an Apple then a Microsoft, then a Google, then even a Meta, just simply because there has been so much angst really about how it's going to deploy AI and whether it can really get some sort of upgrade cycle going?
Yeah, it's a good question. I think you have like a lot of excitement around AI, and AI being deployed by Apple came through over the summer. You saw the stock reacting to that very significantly. And quite interestingly, expectations are very non-tangible, intangible.